Just a sequential slowdown, deceleration in cloud growth, cloud spending growth, and that's weighing on the stock.
Yeah, I get that. I thought Anurag Rana was brilliant yesterday on this. It's a risk. Somebody's going to be right. Somebody's going to be wrong about the vector of cloud growth. But I don't hear anybody saying you're going to see a strategic change in cloud. I will say, John, there's a little bit of zeitgeist saying, here's Google doing better. Here's Microsoft doing better. What's it mean for Amazon? And let's remind ourselves that Cloud Guy came over to take over the company when Bezos went to take over the Washington Post.
Jassy.
Yeah, so that's sort of the triangulation of cloud in America, at least right now.
Next Thursday, Amazon and Apple. You said zeitgeist. This is in the zeitgeist, TK. British billionaire, Tottenham Football Club owner, Joe Lewis, facing charges of insider trading in the United States. We're hearing that federal prosecutors claim Lewis passed on insider knowledge of businesses he was heavily invested in to friends, assistants, and even romantic partners. It's an important quote, Tom, we've got to read out from an attorney for Lewis saying this: the government has made an egregious error in charging Mr. Lewis, an 86-year-old man of impeccable integrity and prodigious accomplishment. Mr. Lewis has come to the US voluntarily to answer ill-conceived charges, and we will defend him vigorously in court.
I thought the Bloomberg coverage of this was very balanced in that they talked about some of the allegations here. Obviously, there's two issues here. One is he's innocent until proved guilty, and also I need to say thank you, Mr. Lewis, for the 2 seats to the tots.
This is what I was waiting for.
Oh, Becca, I'm not biased
at
on
least
this at all.
I just waited to find out.
I'm biased. I think the prosecution's going to bring in Harry Kane to provide some evidence.
I'm pleased you're taking this case very seriously.
There's some serious allegations there.
Can I share one?
And, yeah, we'll share one morsel. There's many.
Just some color that he loaned his pilots $500,000 each so they could buy shares before a company's clinical trial news became public. That's the allegation. That's the allegation, one-off.
In the CFA curricula, about 15% of the exam is ethics, and what you flunk in ethics is insider trading. It is opaque, amorphous. It's not a lot of clarity here, but boy, are some of those allegations providing clarity.
Do you think this disrupts your transfer strategy this summer?
I think Mr. Levy would say no. I think that we need to do some reporting on this. And John, I got to be honest. I mean, we have our legendary R days here at Bloomberg, and I think you and I are going to need to take a bunch of R days to research in this. I'm thinking Arsenal Tots.
We've got Francis Donald of Manulife with us. And, Francis, I just can't believe how transparent TK just was over a legal issue.
Well, in the CFA curriculum, they talk a lot about transparency, and they talk about how you shouldn't even give the appearance of conflict. So, Tom, looks like you've done a great job there.
Yeah, but the other issue is who let her in? The major issue here is insider trading is not as clear-cut as the public thinks. It can get really back and forth about who said what when. I was stunned by the allegations, I would think. Francis Donald is with us right now. We say thank you. Thrilled you're here this morning. What are you writing about this weekend on Y equals C plus I plus G plus NX? What's the dynamic there? Is it investment, or is it the mystery of this buoyant consumer?
We are trying to stick to process even as price moves against our base case, which is that, yes, still all of our leading indicators and our economic model suggest that the best base case scenario is indeed a recession in Q4. Now, that's not actually the game. The game as an asset manager is not to say whether there's recession or a soft landing, but to get a sense as to what markets will price in and out over the next 3 to 6 months. So what we're talking about is that in the next 1 to 2 months, we actually see economic data that will still give the appearance of soft landing. That's an opportunity to chase some risk. But if you're looking further out, if you're looking beyond the next 3 months, we still have to maintain this call. It doesn't feel good as everyone moves towards the soft landing thesis, but when you stick to the leading indicators, we have to say that is the best base case.
What does it mean to lean into risk right now? What are those areas?
Well, there is, even as a macro strategist, as an economist, I can say sometimes you need to participate in momentum-driven rallies. This happens. Macro is not always the primary investment driver. Again, that is not the most comfortable thing to say as a macro strategist, but an overlay, and it matters much more at inflection points. I do not believe right now we are at an inflection point, even though today is a Fed meeting and it may feel that way. That inflection point is to when that recession will probably come back into the story is probably 3 months from now. So if you want to play off momentum, sentiment, and technicals, now is the time to shine if those are your strengths.
Did somebody overnight push their recession call out to 2025? I'm going to say Goldman Sachs, but I'm making it up.
I didn't see that.
Somebody out
25.
there. I mean, everybody's pushing it out. Not 2024.
Well, they have done all year.
Yeah,
They just push it another 3 months. Another 3 months.
Can you raise it to 2026?
Sure, and I'm sure that if you asked any economist, they would have some sort of recession over the next 5 years, because I don't believe that cycles are necessarily dead. But it's a good question, and we ask ourselves this all the time, which is, why hasn't the recession that everyone's forecast materialized? It's probably because, and again, you have to look at what a standard economic model would tell you. You also have to say what may be not true about that model, or what's different about this environment. And a lot of strategists have said this time is fundamentally different. My view is that, well, you can't throw the baby out with the bathwater. There are elements of this story that are going to be very different. This recession that occurs later this year and into 2024 will look slightly different. Unemployment rate probably not going to rise to the same extent. And you do have to question, why isn't it here yet? That's probably because you have what we like to call cycle extenders in play. Things like labor shortages, excess savings. We're not talking, you don't need a PhD to figure it out that there are things that are different about this story, but negating all of history, negating all of the power of leading indicators, to me, is not prudent in this environment.
So Germany has a recession.
Yes.
Europe still has an inflation problem. As you anticipate that growth downturn in the United States, do you also envision that maybe we have a sticky inflation problem too simultaneously?
Yeah, absolutely. And this is actually what concerns me more. We spend so much time talking about recession or soft landing. There are a heck of a lot of environments in between those two things. And frankly, if I'm an asset manager, which I am, and trying to figure out how to invest over the next 5 years, a classic recession rebound, we have a playbook for that. You can do well in that type of environment. What concerns me more, what we don't have the playbooks for, is what Europe is experiencing now. Sticky high inflation with no growth. One thing I'm worried about is actually this concept of the soft landing being green light, being the most bullish outcome. I'm not sure that a soft landing is as bullish as everybody makes it out to be, because we have 4 cuts priced in for next year. And if we don't get those because the economy is all clear, we have a re-rating to be made in a variety of risk assets. I'm not sure that we've really thought through what does soft landing mean for equity markets. It's not as bullish as it may appear.
How much do you think it's a bear market trap almost to lure people back to the 60-40 ahead of what you just explained in terms of the vulnerabilities in that type of maybe soft landing, but high inflation, no growth kind of circumstance?
Well, again, it really depends on your timeline. If you're operating on a 1 to 2 month timeline, it's not a trap, it's an opportunity in order to really leverage what we'll probably see is some cyclicality, some cyclical bounce in things like manufacturing data. But if you're a longer term investor, absolutely you should be looking at these bullish runs as opportunities to add back to quality and maybe reduce your risk. I think it's also going to call into play why there's a lot more focus on alternative assets and private assets. Because in this type of environment, one that John is describing as slower growth, recessions with sticky high inflation, we're going to be looking for asset classes that really reduce that volatility and are less correlated with the 60-40.
Asking for a friend, is the meeting this afternoon, is the press conference this afternoon a snooze fest?
I hope for markets that it is, and I would expect that Chair Powell also hopes that it's a snooze
But what's
fest.
your prediction here?
I don't believe there is anything that Chair Powell could say today that would convince the market to take out rate cuts from next year. And that's because just about everybody recognizes that the Fed does not have the luxury of pivoting. What's happened since the last meeting? We've got ag prices surging, inflation expectations in the longer end of the curve are up quite a bit, and financial conditions are easing. He has no choice. He cannot go dovish. If he does, it'll be a little bit of an accident. So this is a market that's probably going to start putting a little less weight on what the Fed says and more on what 2024 is going to look like.
How do you think he manages what is increasingly looking like a broken consensus on the FOMC?
Well, that's a tough one. Probably like a lot of strategists are doing, which is coming out with a base case and then thinking through all the other scenarios behind the scenes. Goldman does a good job about talking about a base case and then a probability weighted base case. So the Fed can start talking a little bit more about scenarios, but it comes back to the issue that the Fed has to control inflation expectations. I think this is a big theme for the next 5 years, that central banks will have to have a moment where they admit, we don't know what's always going on. And secondly, we can't combat all elements of inflation. That's going to be the story for how markets trade around central banks over the secular theme.
Francis, this was awesome. Come in the studio more often.
I'd love to.
I love it. Francis Donald of Manulife. On the Federal Reserve a little bit later, and market opportunities as well, and the risks out there too. TK, I think for most people today, even if you believe they are one and done, this is a Fed that today tries to retain the optionality of going again, which will shape to some extent what they expect from Chairman Powell in this news conference later.
I predict right now we're going to see him say data dependent. I just think we're going to, it's like AI. We're going to see data dependent, because that's what they are. And maybe, you know, to cut everybody some slack, it is a post-pandemic. We've never been here, but maybe with a pandemic, we're more data dependent than we've ever been.
I imagine the first 30 minutes might be a little bit silly if they edit the first paragraph at the very end when they characterize inflation as being elevated, if they acknowledge some kind of disinflationary improvement.
Possibly.
We'll see if they make a change there.
He won't say transitory. I don't think that word will
After getting burnt a few times.
I don't think that'll come.
You know a journalist's going to ask. Maybe Mike McKee a little bit later in the news conference. From New York City this morning, good morning. Equity futures a little softer. This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's really hard to argue against big tech for the time being, but it's also difficult to rationalize the sort of sustainable reaction of the tech market. How big can the big tech grow?
Deepak Puri there, Deutsche Bank, International Private Bank CIO, asking, I think, a question we've all asked as the year has progressed. How big can the big tech grow? And the answer's bigger as the year has progressed. Equity futures right now on the S&P, negative by 0.1% on the S&P 500. On the NASDAQ, a touch of underperformance this morning. We're down about 1/3 of 1% as Microsoft slips following results, showing a slowdown in the cloud services business. Dan Ives of Wedbush remaining bullish on the software company, writing this. We believe Microsoft is in the early innings of a massive penetration of AI and cloud that could conservatively approach 50% of its global installed base over the next 3 years. We maintain our outperform rating, TK. They raised their price target from 375 to 400, reflecting what they call confidence in an AI opportunity over the next 12 months.
John, 1994, I was standing in the kitchen looking around the corner at the Bloomberg FXC panel, watching the market at 7 p.m. in Asia open in 1994, and there was a thing on the screen called Dogpile. To make a long story short, Dogpile was bought by Google as a key part of their search algorithm. All the others, there were the names I can't even remember now. I didn't see, as wired in as I am, I didn't see the internet coming. I've had the honor at Davos of telling Tom Berners-Lee at this. And what Dan Ives wrote yesterday on this is critical. It is now again 1995.
To have the faith that you can have that kind of transformational
Transformational.
Dan Ives alongside us this morning, and good morning, Dan.
I couldn't tell my eyes.
It's good to see you. I thought you were going to say at the corner of my eye I saw this fluorescent jacket, and that's when I met Dan Ives. Dan, I always reflect on this video, and you've heard this story before, forgive me, but you remember the clip from 60 Minutes in the late 90s, and there's this very sort of smug journalist asking an analyst about Amazon being bigger than Sears and saying, bigger than Sears? And you look back on it 30 years later, 25 years later, and it sounds ridiculous. So in moments like these, I try and be maybe a little bit modest about what I don't know and try and be a little bit, humility is the word maybe,
yes.
Bramo, just, try and have some humility about this AI moment. Dan, do you think we need a bigger dose of humility about how big this could be?
I mean, I think it's even going to be bigger than the street is even anticipating. And I think what we saw from Microsoft and Google just further confirms what we saw from NVIDIA. I mean, the use cases are exploding across the board. And I look at this as a 1995 moment, biggest transformation that we've seen in tech in 30 years. And I think that's why this is just what's going to lead, obviously, despite Fed and macro. It's the start of a new tech bull market, in my opinion.
There is the nuance, though, when people start to dig into what does AI mean and which areas are the investable and most lucrative areas. Is it going to be generative AI, where basically you can go to any retailer, put your avatar in, try on clothes, and then order things? Or is it something else? What are you looking for to determine who the winners are going to be? Yeah,
well, right now, New York City cab driver knows that the first derivative, NVIDIA and Microsoft. And I think that's been proven again, top of the mountain. Now it's all about who's second, third, fourth derivative. It's really software and chips. When I look at names like Salesforce.com, MongoDB, you look at Snowflake, I think that's really just tip of the iceberg. I think others across the chip ecosystem. And what we're really starting to see now, it's all about use cases. That's why right now investors, they're just looking, if you look at, it's expensive on next year's number, it's really looking out 2, 3, 4 years. I believe this, from everything we're hearing, it could be 8 to 10% of budgets next year for IT from less than 1% today.
So if you take a look at the price action today, with Microsoft shares lower, because they didn't necessarily deliver on the profitability of AI yet, they can't, they're investing still, and they're not delivering as fast of some sort of investment on the cloud space. What would you say to investors in terms of how they should look at this valuation, how they should look at some of the rejiggering of the top executives, and put a price target on that?
Yeah, it's a great question. And that was all my conversations last night and even earlier this morning with institutional investors. Look, Nadella, the tactician, the Hall of Famer. I mean, this is just getting the popcorn out ready for what I view as actually an accelerating growth story. They're not going to, they're not Cook style going to give their playbook away. They're going to keep this conservative, and I view just a sandbag special as they continue to just beat numbers over the next few quarters, which is why I believe Microsoft, a year from now, it's going to join Apple in that $3 trillion, I think 3.5 trillion, what I see in a year.
George Hammond writes in the FT today about the AI crew. He's got Anthropic, Google, Microsoft, and OpenAI. Okay, I guess that's the new industry organization around this. The Luddites are going to show up. We're going to do a 19th century redux here of the damage of AI. How do these giant companies with the profitability they have handle the 21st century Luddites?
Look, I think stronger you can get stronger. There'll be some self-regulation. But ultimately, if you look from a regulatory perspective, they're going 20 miles an hour in the right lane. Technology is going 100 in the left lane. So I think really the stronger and get stronger. If you look at Microsoft, you look what we see out of Alphabet, that was a huge flex the muscles quarter for them.
Oh, I like the CFA talk.
And
flex the muscles.
It was a huge flex the muscles quarter. And that's, look, this is one, if you're a bear now coming a little out of hibernation mode, thinking that you want to.
Why are you looking at me?
No, if you're a bear coming a little out of hibernation mode, right. I think ultimately what you saw from tech earnings, just more and more bullish.
Okay.
And I think next week is going to be the golden moment.
That's where I want to go.
Cupertino next Thursday. I don't care about all this
AI talk. I want to know about next Thursday, Amazon and Apple. Amazon's not in that list of AI companies. I think they're in the cloud. Apple certainly isn't. How does Apple embrace AI? How did they get on this list of these companies?
Cook continues to play chess, others play checkers. And I think what we believe it's going to be an AI-driven app store. Gurman's hinted at some of the AI technology, but I ultimately believe the next 1-2 years, that's just going to be a further penetration story. Adds $30 to $40 some of the parts to Apple.
Can it protect their margins down the income statement? How many beeps can Apple pick up on EBITDA, let's say, out of AI 5 years out?
AI combined with chips, you're talking incremental 300-400 bips. That's just
300 bips
300 to 400 bips improvement because they own their ecosystem plus AI being pure software.
How quickly do they get to $4 trillion market cap off a 300 bip improvement?
I believe we will be sitting here in early 2025, getting ready for Super Bowl, and Apple will be $4 trillion.
Okay, breathe. So I acknowledged that in the late 90s, there were some real things that we didn't appreciate. We also got sold a lot of BS. So can you explain to me, and I wish we could curse on this show, could you explain to me what is an AI-generated app store? What is that?
So that's ultimately going to be, whether it's health, fitness, any types of apps developers are going to build, they're going to be AI-generated with all what I would call generative AI technology that we built within the App Store. So ultimately, any Apple user will be able to download those apps for developers. Just like we have the App Store today, the next version of that is going to be an AI-driven App Store that I believe Cupertino will ultimately come out. And I think they're actually starting the concept of it with, Vision Pro and ultimately a new form factor.
In the meantime, it's not going to be about that. It's going to be about how many iPhones they sell. For a long time, you've been bullish on this upgrade cycle that kind of never was. And it's always been the justification for why the stock's got to go further. So a lot of people that haven't upgraded, they're going to buy the iPhone 13, 14, 15, and then it kind of remains the same and pretty stable. What's going on there?
Street numbers have moved up 15% on iPhones. So the thing is, the bears ultimately thought sub 200 million, but yet they sold 225 million because they continue, and Keen, the tactician, knows as well as anyone, they continue to underestimate the golden install base of Cupertino, which is why I view this as a mini super cycle playing out. And I think Apple next Thursday, Cook on the call, that's just going to be further what I view as fuel in the engine for this upgrade cycle.
Here's the upgrade cycle. I just took a photo of Dan's shoe. The saturation on this phone is so superior to anything.
And it still doesn't capture the colorfulness.
It doesn't capture.
And look at that camera technology and the chip.
Isn't the Samsung camera better?
Yeah, but this is a really important point. Overnight, we got 30
Hasn't
seconds.
It always been better?
When does Samsung just give it up? The report overnight was not good.
Look, Samsung, Everest like uphill battle, another sort of black eye for them. And I think ultimately it continues to be more and more share gains for Apple. And I think, look, Samsung, it's a continued struggle that they have again and again.
Dan, it's good to catch up. I know we're going to do this together the next week. I'm looking forward to it. Thank you, buddy.
I'm going to put this out on Twitter. Ives, unfiltered.
Unfiltered?
Yeah.
Just a picture of his sneakers?
Yeah.
Okay. Dan Ives of Wedbush. So much more than just a pair of Nikes. Coming up, Sina Shah of Principal Asset Management from New York City this morning. Good morning. Futures right now on the S&P 500, negative 0.1%. We talked a lot about Microsoft and Alphabet. Next week, you'll hear from Apple and Amazon. After the close, a little bit later, you'll hear from Meta. And before we get there, is Chairman Powell and a Federal Reserve decision. Special coverage through today, right here on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, Should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So a dollar there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
News breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI, semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Inflation remains well above our longer run goal of 2%.
We're likely to need a couple more rate hikes over the course of this year to really bring inflation back.
It can take some time and assess and collect more information and then be able to act.
I do believe that underlying inflation is declining gradually and in a way that may well be sustainable.
I would say we're close, but we still have a bit of work to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Fed decision just around the corner, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio, alongside Tom Keene. Bramo's back. I'm Jonathan Farrow. Your equity market's negative by 0.2%. Chairman Powell, 2 p.m. Eastern Time. We get a decision, then 2:30 a news conference. Tom, a little bit later after that, earnings from Meta, following numbers from Alphabet and Microsoft yesterday afternoon.
And we're seeing Coca-Cola right now. Lisa, jump in here. I mean, John, I'm sorry. This is a big deal here. Organic revenue growth 8 to 9%. That's the heart of this earnings season. Everybody thought, John, those numbers would come down for Meta, for the rest. Everything's going to come down. You know what? I'm seeing a lot of research notes saying, maybe not.
What we're seeing right now is Coca-Cola raising their guidance for the full year. That's what a lot of people are looking for, with earnings per share coming in at 78 cents, beating the 65-cent projection. But what I find interesting, John, is even in the lower end items, you're seeing consumers able to keep spending above expectations, and that is the story that the Fed needs to pay attention to.
Discretionary spending has remained elevated away from the staples and some of those names out there at the moment. It's been a year of airlines and cruise lines, Lisa.
And we've seen that pretty consistently, both front up and personal.
Are you
as
living
well.
it?
I'm living it as well in terms of the crowds. But this really is the conundrum, and it goes to what we heard from Francis Donald. What is the risk that the disinflation trends are a head fake, and then what we're seeing is something that will be stickier even as growth slows and people's discretionary spending pools, pots of money, start to wane?
Two names. Max Kettner, HSBC. He came on a program an hour ago and he said he expects inflation to reaccelerate. Andrew Hollenhorst, Citi, expecting inflation to reaccelerate. So let's get a third name. You mentioned the guest just moments ago, Francis Donald. She was talking about a recession, Tom, but a recession with sticky inflation. And if you're scratching your head about that,
that's a belief.
Search no more, look to Germany. That's not a belief, that's the reality. Got a recession in Germany. Inflation's still a problem for this ECB as they meet on Thursday.
Well, let's be clear here, folks. And I think, John, you and I said this yesterday when Bramah was away. The basic idea here is the ECB meeting is more important than what we're going to do today.
I think it's fascinating.
Obviously Chairman Powell's not going to mention it, but he has to be aware as central banker of the world of the challenges of Germany and, frankly, France, and how it redounds over onto the America.
And how does he express hawkishness when everyone knows he has to express hawkishness? He has no other option. And how does he give any convincing argument for it at a time when you're seeing more splintering on the FOMC than you have in months?
I can't tell you how many notes I read yesterday afternoon that said some version of this. We think one and done, but they retain the optionality to do more in September.
When we leave, you keep working?
I keep working.
Really?
I read research, Tom. Do you do any of that?
Pretty shocking.
Any research, TK, in the afternoons?
I don't know. That's a Roman day.
It's a Roman
That's
day.
what we call those Roman days. It's like you're working like the Romans years ago.
Okay.
Yeah.
Did they work more or less than us?
They work 80 hours a week.
I imagine they worked less than us.
I clock out at 10:01. See ya.
Well, I clock out with you at 10:01 too.
Yeah, but you keep working. I don't.
True.
I'm off,
Equity futures on the S&P look like this. On the S&P 500, we are negative by 0.2%. In the bond market, we are virtually unchanged with a 10-year at 3.89. And the euro, unlike the previous 6 sessions, showing some strength today. Lisa, euro dollar 110.81.
And really the main event is going to be at 2 p.m., as you were mentioning, where we get the FOMC rate decision. If you want to join us, you should. We can start at 1:30 p.m. We will be back. You will not be clocking out at 10 a.m. We're going to be back in the building, and we have Bill Dudley, the former New York Fed president, Bob Michael of J.P. Morgan Asset Management, and Diane Swank of KPMG. 10 a.m. before that meeting, we get June new home sales. This, to me, is the conundrum, a reacceleration in a space that was supposed to be interest rate sensitive. We saw prices climb a bit higher on the month-over-month reading yesterday. And aftermarket meta earnings, and this does follow what we saw already from Google or Alphabet and what we saw from Microsoft, the consumer discretionary spending, the retailer spending on advertising, that has been strong. Corporations not spending as much, and that theme, I think, is really interesting, John.
Looking forward to the earnings a little bit later from Meta. Joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, wonderful to catch up with you on a Fed decision day. Let's start with Chairman Powell. What are you looking for in the news conference later on this afternoon?
Hi, John. So we have had a fairly long-held call that rates would peak at 525 to 550 in that range, which is where we're going to hit today. That is fully priced in. It will provide no shock to the markets. As you said, the real interest is going to be in the press conference and what is Powell saying. And you just have to look at the strength of the economic data to know that they almost have to put aside the most recent CPI print, which was softer than expected, and really focus on that continued stickiness of inflation or the threat of a resurgence on the tightness of the labour market as well. So I think it pays them well to make sure that they maintain their hawkish stance. They cannot risk a further easing in financial conditions. So I think that's going to be his tone. But we have to remember Powell, when it comes to question time, has a tendency to let his true self out. So that's going to be what we're watching.
Is the mistake, which is what everyone seems to be looking for. What kind of dovish mistake might slip from Chair Powell? In the meantime, one after the other of some of the cautious investors have been putting up mea culpas, including Mike Wilson of Morgan Stanley, saying he got it wrong with respect to the rally. You've been cautious. Have you thrown in the towel and said you need to lean into this rally? Or are you saying, okay, perhaps it hasn't borne out the way that we thought, but it will?
So we're a little bit in between. So as you said, we have been cautious. We have been expecting the economy to slow a lot more than what we've seen so far. We've been right on the Fed decision. So it's a slightly weird situation where you've got the inflation numbers almost correct, but the growth numbers haven't, matched up in that way. From our perspective, we are expecting a further pullback or a pullback in equities. But because our recession call is one which is very short, very shallow, a 2-quarter recession, a 1.5% peak to trough in analyzed GDP growth, very, very small. So we are expecting to see a bit of a pullback, maybe a 5 to 10% move, and then we're going to be looking to get really risk on. But we're not at that point right now.
So do you shrug off the idea that we were hearing from Francis Donald, from Max Kettner, that you could end up with some sort of slowdown but still sticky inflation, which creates a non-optimal moment for risk on?
So I don't know if I'm quite there. I do think that you're going to see a slowdown in economic growth. And I think one of the things is, what do you define as sticky inflation? We do not buy into the argument the Fed needs to see inflation at 2%, 2.5%. We think they'll be fine. So I think the thing is that we are expecting to see continued deceleration as the economy slows, and that the Fed will be in a position at some point next year to start cutting rates. That doesn't mean that they're going to move into loose territory. I think that policy is still going to be very restrictive. If we're wrong about the economic growth scenario, and actually you do see this continued melt up in the economy, well, yeah, then that's going to be accompanied by a resurgence in inflation, and then you're looking at further Fed hikes. But I don't think we're sitting right in the middle between those two.
Seema, I'm so glad you're here because I've got something on the Bloomberg screen I've never seen in easily 30 years of dealing with the Bloomberg terminal. I got Coca-Cola with a 3% FX headwind, lower than the drama of last year. FX is getting more stable off dollar. But I've got at the revenue line unit case volume of 0%, and the headline right after it says organic revenue growth is being modeled at +8, +9%. I've never, ever seen that spread between 0% and an 8% view for the future. Can companies raise into this inflation cycle? Do they just keep raising prices, or does that end at some point?
I think it has to end at some point, but you're going to see this bifurcation with companies, right? The companies that have the brand, that have the pricing power, will continue to maybe creep in some of those price increases. Coca-Cola is a great example. That's got a really strong brand. That is likely to be one of the outperformers. If you're a smaller company which doesn't have that branding power, as inflation is coming down, you're going to find it more and more difficult. So for us, as well as taking that big macro view on where you want to be focused, you do need to start thinking about that pricing power, brand quality, and whatever your view is for the economy, if you believe that inflation is coming down, that has to be a part of your strategy going forward.
Does Principal see value in international investment right now? I talk about 2023, my theme for the year, the great zombie roll-up. That's implied American. Can there be a great zombie roll-up to scale and quality worldwide?
Well, look, I think there are opportunities internationally. You have to look for them really carefully. And one of the things is because this environment is quite difficult to read. We've been talking, there's a lot of difference in views at the moment. You almost have to start focusing on some of those longer term themes. So for example, for us, when we look at international equities, we're thinking about reshoring. Where is that reshoring taking place, especially as China continues to disappoint? So there's going to be areas within EM Asia which are looking pretty good. In Latin America, where you have reshoring really as a key focus for parts of Mexico, those valuations are also looking quite attractive. And you have some central banks which are starting to cut interest rates. So I think you can look outside the US. The tech story in the US, I think, is still compelling from a long-term perspective, if maybe a little bit dicey in the short term. But that, for us, is the way that investors should be playing this right now. Don't think about the near term because it is quite confusing. Think about what you're looking at over the next year, couple of years out.
Seema, the risk on choice was basically, do you want luxury out of Europe or tech out of the United States? Do I want luxury out of Europe after what I've heard from Richemont and LVMH in the last week?
No, you don't. And the reason is it's not actually about the European consumer necessarily. It's really about China. So, as Lisa was saying before, in China, actually, the consumers are doing okay for a lot of these companies. But what you're not seeing is some of those this kind of spillovers to other economies. And one of those is the luxury goods sector in Europe, which was anticipated to benefit significantly from China's strength. Now, you're seeing a Chinese recovery, which is very, very lackluster. But also, any of the benefits that do exist in China are just not spilling over to the other markets. So I would still play the tech trade rather than the luxury trade in Europe.
LVMH down 5% in European trading this morning. Seema, thank you. Seema Shah there of Principal Asset Management. These fears over the European market creeping back in based on the data out of China. We had some happy talk out of the Politburo a little bit early this week, encouraging maybe a lifeline in Chinese equity markets, which have struggled relative to the performance we've seen elsewhere. But Lisa, is that sufficient, just talk, or do we need to see some real stimulus come out of that country?
I was reading an article in one of the analytical journals about why China cannot stimulate in any kind of sustained way. They can't go back to the same well of housing and inflate a bubble if they don't solve some of the entrenched political problems with the local governments, if they don't solve the problem of it not responding to supply and demand dynamics. And that, I think, is the quagmire they found themselves in.
Are elements of a balance sheet recession starting to emerge in China that maybe you just can't do much about? If you are just tuning into the program, welcome to the program. On the S&P 500, we are negative here on the S&P by 0.1%. 0.2%. Coming up on the equity market in the next hour, looking forward to this conversation, Alicia Levine of BNY Mellon Wealth Management, always one of the best, TK. That conversation just around the corner.
Really bringing a lot of mathematics into it. I really want to talk to her about the tail risks that are out there right now. I think we're going to get some optimism from her, but it's not only the tail risk, but also, John, the tail risk of the gloom of the left over to the right tail, which is the optimism that's out there. I wonder this weekend how people again recalibrate to a bull market.
Looking forward to catching up with Kathy Jones of Charles Schwab as well. She'll join us in about 15 minutes. Before we get there, we need to get down to DC and catch up with Bloomberg's Anne Marie. Sometimes the good news are things that didn't happen. The good news for this administration, the strike from UPS, Bramo, that probably won't happen now because I understand, a deal on the table. Good news for the Biden administration, I'd say.
Massively good news, partly because there was a concern about does he step in and stop a strike that would halt a major part of packages that I know Tom Keene and many others rely on every day for their basic goods and then some. And that really was a concern hanging over it. Now the concern shifts. Wage inflation. How much union pressure is there going to be? And this isn't just the Teamsters. There are a whole host of real labor pressures that are percolating up.
I'm going to talk in the 8 o'clock hour to Sean O'Brien, who's the head of the Teamsters. What an interesting story out of Local 25 in Boston. And it's real simple. My first question to him is Amazon the next UPS for the Teamsters?
Interesting. That conversation a little bit later on this morning. Coming up next, Anne Marie down in Washington. Your equity market negative 0.2% on the S&P 500 from New York City. Good morning.
ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
The ECB is still catching up.
They want to hike and show strength when they actually should show caution.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Are we at the end game for the ECB?
Those questions will persist up until Lagarde goes on that podium.
Coverage begins Thursday on Bloomberg, your global business authority. Wednesday, the market expects another rate hike.
They're getting the message loud and clear. The Fed wants to go again.
The then what is the big mystery.
But will it be the last of the cycle?
Is it one and done or more to come?
Does the Fed make policy based on what they're worried about or what they actually see?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Twice more is not too high of a bar.
The Fed wants all options on the table.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
I think it's quite likely that we're going to have a shutdown. There is a group in the House that thinks a government shutdown would be a good thing, both politically and in terms of governance. And the bottom line is we cannot run our country, one, without a budget, which we still never really have, but two, with this amount of chaos. Shutting the government down cannot be the solution. We have to fix our both broken budget process and we have to figure out a way to compromise on the actual budget.
The crisis that never was on repeat over in Washington, D.C. That was Mayor McGuinness there, the president of the Committee for a Responsible Federal Budget on Balance of Power in the last 24 hours. From New York City, welcome to the program. Big day ahead for many of you. Federal Reserve decision a little bit later. Consensus view, we get a rate hike. Then it's about the news conference and the what next from Chairman Powell 30 minutes after that. So 2 p.m. for the decision. 2 p.m. Eastern Time, 2:30, 30 minutes later, you get a news conference with Chairman Powell. Coming into it, equity futures on the S&P 500, just a little bit softer on the S&P. TK, we're down here by 0.15%. No drama this morning.
No drama. I'll go with that. But again, I'm with you. I'm looking tomorrow to Lagarde and the ECB and how they finesse true slowdown there, is mentioned by IMF, even with a little bit of IMF optimism. Yesterday, John Torsten Slok publishing moments ago, and this is in the zeitgeist this week. It really hasn't been talked about. We mentioned it yesterday on the show with some fixed income strategists. Loans. These aren't car loans. These are not house loans. They're packages of what I'm going to call fixed income, not derivatives, but structured securities, oftentimes leveraged. And Torsten Slok puts that in the zeitgeist at Apollo today.
Defaults are starting to pick up.
Yeah, this is the Bramah world.
We're hearing more and more about that, Tom.
Yeah, and I don't think it's a small issue. I just, and Bramah, where are you on this? Are leveraged loans the same as a bond?
They're usually sensitive and they increase in rate with the increase in benchmark rates, which means they are that much more interest rate sensitive. You are seeing concern there. And yesterday, I'm sure you guys talked about what we saw out of Europe with a massive decline in loan demand, the biggest decline going back to at least 2003. And that, I think, is what we're going to hear about from Christine Lagarde tomorrow.
We're going to Washington right now in the sleepy days of July into August. Much going on. Terry Haynes giving us a Pangea approach here on some of the politics of the moment, but far more seriously, and with security around her when she's on the lawn of the White House, Anne-Marie Horder, on what matters to dog lovers in America. Vet Bill asked me to ask this question. Anne-Marie, you gotta be kidding me. Everybody growing up knew a dog in the neighborhood like Commander. Commander's biting Secret Service agents. I mean, this frankly is not funny. Is Commander going to Happy Farm out in Delaware? How do they solve this? If they can't solve this issue, how can we believe the president can solve the nation's serious issues?
Well, it's a good question when you frame it like that. This dog, there's several emails are showing, has bit a number of Secret Service agents. They did have another dog, Major. He had followed a similar track, and he was sent to a family, friends in Delaware, and potentially Commander's going to face the same fate. That's all the details I have on this.
Have you ever met Commander? Have you ever, like, you're hanging out in the White House in the East Room like you do, or the Green Room, the Oval? Have you met the Beast?
I've seen him run around unleashed in a garden part of the White House, but I never wanted to go over to him, and I love dogs, but I never had this urgency to want to go pet Commander.
There you go, Lisa. This is the insight you get from Balance of Power every night at 5 p.m.
Are you trolling Anne-Marie?
No, I think it's great. She's out there. She's at risk on the White House lawn.
I will say,
continue.
It was interesting to me what it says about where we are in the news cycle also, that this was the top story for a lot of political outlets, was that there were attacks by the dog. It is potentially a serious story that I'll let other people deal with. I am curious your thoughts on the resolution that we got with UPS. We are going to be speaking with the head of Teamsters coming up, but I'm curious from your vantage point how this is being received in a White House that did dodge a bullet on one hand, but also is facing very much of an inflation problem on the other.
I think the White House is breathing a big sigh of relief. I think Teamsters made it pretty clear they didn't want the U.S. government, they didn't want the administration to get involved. They wanted to hammer this out themselves with UPS, and they were able to get a deal that they seem to be happy with. Of course, this is a provisional deal. They have to go back and make sure that this can get through all the members of their union. Remember, there was a hiccup last time with the railroads because there were some members of the group that were just not going to go forward with it. But it does seem like this this is a deal that they are happy with. And it is just a huge sigh of relief for the president, because many were thinking, I mean, Greg Valliere in his note today said his thought process was there would be a day or two at least of strikes from UPS workers. And that would have been incredibly troubling for this administration, for the Fed, that they are trying to bring inflation down to 2%. Could that have stoked higher inflation? Could have been another issue for the supply chain bottlenecks this administration for a year and a half really tried to work to unwind. So this is something that, of course, is welcomed by the White House. And anytime you're seeing a union president come out and say that they are fighting for higher wages in America, this president is going to want to embrace that. He wants to go down in history as the most pro-union labor president, and it comes at a time where this is the kind of rhetoric he'd want to see going into 2024.
And this is probably what he wants to be the headline instead of his dog and potential bites, and instead of other things that are coming to the fore. What does that say about his popularity as we head into an election year at a time where the race is really heating up with potential Republican contenders ahead of next month's debate?
Well, the president's approval rating is about in the 40s. The issue he has more so is that his economic approval ratings is in the 30s. I still cannot get over this Monmouth University poll that says only 3 in 10 Americans think the U.S. is doing better coming out of the pandemic economically than the rest of the world, because this administration continuously likes to show that coming out of the pandemic, look at U.S. data versus the rest of the world. We're doing much better. Yes, when you look at the data, it does feel like America is out front coming out of the pandemic. But the issue, of course, is that is not how Americans feel. They are still feeling what we had in terms of higher inflation. Yes, inflation is cooling, but prices were still elevated, and Americans are still feeling that. And that is a huge problem going to 2024. And it is why the administration is trying to own this term Bidenomics and explain to the American people all the legislative wins they've had and potentially try to shift them on how they feel about the economy. The other big question, of course, is whether or not we would see a recession before 2024. But if there is a soft landing, the timeline could potentially be helpful to this president.
MH, thank you for everything, then. Anne-Marie down in Washington, D.C. on a range of stories. Problem is for the president, Tom, Bidenomics means different things to different people.
Oh, yeah, you know, come on, it's a concept.
As always.
You throw it out, see if it sticks on the wall. And, you know, as you say, it means a lot of different things to different people. Guess what? Bidenomics is about the next jobs report. It's about the next inflation report. You talk about data dependent, you just stagger forward with these political phrases.
Is it about the front cover of the New York Post? Have you seen that headline on the New York Post? That is brutal.
Well,
that is brutal. You brought up the dog. I don't bring up the dog. There's an easily startled, confused creature in the White House prone to fits of anger. There is also a German Shepherd.
Personally, I've been through this with a dog. It's not funny. And the answer is you got to fix it. I mean, the issue is not the bite. It's the bites, plural. I mean, come on. It's
not the first time.
Not the first time.
But I think to Lisa's point, the fact that that's the front page this morning, and it's not about avoiding a strike that could have included, Lisa, 340,000 union members.
That's the issue.
That's the problem.
And the perception and the fact that every gaffe and every trip and everything gets highlighted in this new way is a serious problem. And you do wonder what the Democratic Party is thinking about that, as you do have a host of potential Republican suitors lining up in Milwaukee.
Who's going to turn up to that debate stage next month?
Good question.
What I'm fascinated about, and this is what the pros like Anne-Marie bring up, is the money raising. I've never been really focused on money raising, but every single adult we have, including Matt Shirley, who arranged is all this for us, they all talk about money first. I don't. They do.
Did you see Ron DeSantis cutting a
35%.
significant part of his
Mike
staff?
Pence can't raise money. That stunned me. Terry Haynes even mentioned that. He was shocked at what Pence cannot get done.
I believe that Republican debate clashes with Jackson Hole. Have you noticed that?
We have team coverage from Wyoming. We get to Cheney, the former vice president.
Maybe we go to Milwaukee first.
Exactly.
Get the two Cheneys. The two Cheneys Lakeside. Two Cheneys Lakeside.
Equity futures negative from New York. Good morning.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
It's a dog-free zone for the next 10 minutes, or maybe the rest of the morning. I can't predict what TK is going to talk about. From New York City this morning, good morning. Equity futures on the S&P 500, slightly negative on the S&P by 0.16%. Bit of underperformance on the NASDAQ. We're down there, Tom, by 0.2.
F1, qualies are Friday, not Saturday. What's that about? What is a sprint race?
So we've got a sprint race.
What is it?
This weekend.
I don't understand. Explain.
It's shorter, no pit stops.
Why do they do it? It's like a pre-race.
I still don't really know the rationale for
it.
I
don't feel like an idiot.
I'm not a big fan of it. I think it takes something away from race day on Sunday.
And qualies on Saturday were like lights out.
Yeah.
I mean,
I'm with you. We're on the same page about that.
We're on the same page.
I'm not sure where that conversation came from, but I'm
also,
with you. I'm pleased that was top of mind.
In the pit, dog-free. In the pit.
You hope. Yeah. You hope, otherwise that would be chaotic, Tom.
Let's continue.
Let's get to the bond market. 2-year, 10-year, 30-year. I wonder if Daniel Ricciardo comes up in a minute, but I've got no idea. Yields unchanged, 388.46 on a 10-year. 2-year yields lower by a single basis point, 486.40. We did this in the last hour. I think it's worth doing it again. It's an exercise I do every single Fed meeting we have. I compare the market to where it was at the last Fed meeting at the close. And Lisa, back then, the 2-year was at 469. We're higher now. The 10-year back then at the close was 379. We're a little bit higher now. And that's developed even with evidence that we're embracing this disinflationary soft landing.
There's a feeling the Fed's going to have to keep rates higher for a bit longer, but not long enough to torpedo the rally. And this is the uncomfortable balance that people are trying to justify at a time when the Fed has to somehow signal something about inflation that is basically a mystery right now, where indicators aren't really giving a pretty good read.
And no mystery over at the ECB. The ECB's got a problem. Inflation's sticky. Germany's in recession. PMIs this week, terrible. German business confidence, not great. The euro has had a string of weakness, 6 days of it. It's bouncing back today by 0.15%. The euro against the dollar, 110.72. Under surveillance this morning, investors expecting the Federal Reserve to raise interest rates by another 25 basis points. A hike today would put rates at their highest level in 22 years. Two-part story, decision at 2 p.m. Eastern Time. Then you get a news conference with Chairman Powell at 2:30. The first paragraph of the statement is where my eyes will go initially. How they characterize inflation, Lisa. At the moment it reads, inflation remains elevated. Do they embrace the improvement, the progress we've made more recently?
And if they do, how do they avoid an accident? Because most people would say that is really teetering near an accident of sounding somewhat dovish when they have to sound hawkish, because everyone's just going to assume that they're going to be more hawkish than they actually are. I mean, basically, this is the psychology of these meetings that Tom loves, and I know that we will be parsing through today. Join us at 1:30, going all the way after the meeting. That's the promo.
That's the promo. Can't wait. There. Tom might stay awake the whole 2 hours. I might stay awake with him as well. And
touch and go.
Tune in just to see if that happens or not. Earnings later after that. Romain Bostic and the team, Scarlet Fu, Katie Greifeld are going to break down what happens with Meta. We need to break down what happened with Alphabet and Microsoft overnight after the close yesterday. Alphabet's positive by 6% in pre-market trading, beating expectations, particularly in advertising, which might be a read across for Meta. Microsoft heading in the opposite direction after a slowdown in crowd services. Really not enough to offset what is positive in terms of the artificial intelligence story. Microsoft this morning is down by about 3.6%, TK, and I believe we had Boeing just moments ago.
Boeing's moments ago, I mean, Lisa's up to speed on this, but it's real simple, John. Boeing, and I wasn't aware of this, it's single digit over the last 10 years. It's been with all the news and airplane problems and that. 9.1% return per year for the last 10 years. Lisa, off the bottom of October, up 82%.
And this highlights the divergence that we're seeing right now. You were talking about Microsoft and Google, and it really is the consumer spending that's fueling some of the ad-driven gains that you're seeing in some of the tech names. When it comes to consumer spending, Boeing is going to take advantage of that with plane orders suddenly picking back up. We saw Hilton just a moment ago as well, beating expectations. Why? Everyone's traveling, everyone's moving around, and this story is really going to continue throughout earnings, and we've seen it. For how long remains the question.
Pretty decent beat from Boeing this morning. Stock is up in a pre-market. The last story I think we need to stay on top of, never mind the dogs and all of that stuff and the gaffes of the president. This is the story right now. UPS reaching a tentative agreement to renew a 5-year labor contract with the Teamsters Union. This has avoided a strike, potentially, and we hope it will, that could have started as soon as next week. Teamsters President Sean O'Brien saying this: we put a lot of pressure on them in the media. We put a lot of pressure on them in the street, and we weren't going to reach out to them. They blinked. Tom, maybe this captures the moment we're in for labor and labor leverage right now, but this could have been a real strike month end. 340,000 people.
A giant backstory to this, which is really important about Sean O'Brien. I'm not going to go into it now because our guest here, John Forward, is so important. But this is a kid, and I mean a kid, out of Local 25 in Boston who went up against all of the stereotypes every viewer and every listener has about the Teamsters. He did this a number of years ago. It involved immense courage, and the payoff was today. And the first thing out of his mouth is Amazon's next.
They blinked and Amazon's next.
His basic take is years and years of UPS. When he took over, he would suggest they screwed it up with UPS. They fixed it overnight with an agreement. They came to an agreement that benefited both the employer, Big Brown, and also the Teamsters, 300,000 plus people. And he's moving on to that model applied to other union-type organizations. And I would suggest if you drive down 3rd Avenue, Amazon's part of that discussion.
Teamsters President Sean O'Brien coming up 8:45 Eastern Time, an hour and 10 minutes from now, TK, on this program.
It's going to be interesting to see right now in the bond. John, I'm going to bounce it back to you here. Kathy Jones is with us. She's chief fixed income strategist at Charles Schwab. And I think this is underplayed, John. There's been real stasis here, the real yield stasis, 10-year yield stasis. All my radar's up on the bond market because it's boring right now.
Kathy, let's get to it. Will it be boring at 2:30 Eastern Time?
Oh, I'm sure we'll get some excitement, you always do. But, as you said, that's widely anticipated. The Fed's going to hike, and then what's forward guidance going to be? And I think the expectation is they'll sound hawkish, but they may indicate a pause. How does that get parsed out in the Q&A session? What does Paul kind of communicate here? Will we get a dissenting vote, possibly, or at least a hint that a handful of Fed officials are not on board with more rate hikes? That could communicate a lot to the market.
We've spoken to a couple of people this morning who think that inflation reaccelerates later this year. I just wonder if that's in your base case and what it would mean for a yield curve right now that's already deeply inverted.
Yeah, we don't have a real acceleration in inflation built in. There's a lot of disinflation in the pipeline that is still flowing through, especially when you look at wholesale goods prices. And we're not seeing that huge amount of pressure on the inflation side. Of course, you have oil, which is going to be there, but ex-food and energy, it doesn't look like we're seeing a reacceleration at this stage of the game. Growth is still substandard. It's been 5 quarters of 1.5% GDP growth. It's really hard, I think, to push the inflation narrative from there.
Would it be bad if Jay Powell came out and said, we have no clue. We don't know where this is going. We're going to pause. Raphael Bostic is going to dissent because he probably will, because he's been the lone dove out there that's been pretty vocal. All of us aren't sure. Here's what we're watching. Call it a day. Why can't he just do that?
I sort of wish he would, to tell you the truth. But I think the Fed has to, they have forecasts, they have to communicate some sort of confidence about going forward. But, you know, the truth is they don't know. They never know. Nobody really knows what's going to happen in the next few quarters. They can only follow the indicators and the trends. We have, as Tom mentioned, very high real rates. We have tightening credit at the banks a lot. And we'll get the senior loan officers, I think, pretty soon. I would imagine the Fed has done some work on what's going on behind the scenes at the banks. We're not waiting for the quarterly report to come out. So they may have a feel for just how tight credit is getting. So those are all going to go into the equation. And then QT continues. We've still got that going on in the background. So tightening is still happening, even if they pause. And I think that that may be part of the message that comes out.
And one aspect of this, and we're seeing this in terms of two-year yields going up as high as they have, higher than the previous meeting, even as risk assets continue to rally, can they, with conviction, say they are not going to hike next year and really push against people who are saying, well, it might be a recession? Could they give some indication of how high the bar is for them to really ease?
Well, Powell, I think it was last November, outlined 4 things that he was watching for a pivot, for a change in rates. And one was this disinflation from the wholesale markets to retail pricing. You could sort of say, yeah, that's happened. He's talked about a sub-trend GDP growth for a number of quarters, where I would argue we've probably had that over the last year or so. He talked about slowdown in housing prices. We're starting to see that, but it hasn't flown, kind of flowed through to the data. And then I think that there's the wage data. And so we have to wait for that. So I think they could outline the criteria and then say, this is what we're watching. I think they've kind of outlined it in general over the last year or two. But we're waiting to see all of the boxes get checked. We're waiting to see everything kick in. And I would argue that, the labor data is probably the final one.
Let's go from 60,000 feet down to 6 feet. I'm over a kitchen table this weekend. I'm still not recovered from the bond debacle of 18 months ago. I thought bonds were always supposed to go up. What is the retail recommendation to participate in fixed income out to 2026?
So we like extending duration either with a barbell or, let's say, a ladder.
Ladder out is appropriate?
Yeah, laddering is fine because it takes you out of the game of trying to time the market.
Give us a duration gap on that, a maturity gap on how you ladder up.
Yeah, we like a 1 to 7 year right now, but it depends if you're in the muni market, you might want to go a little further out because the
like
curve
30
is
years
sloped.
or the Austrian piece?
No, Austrian pieces.
That's what I did. I'm killed. This is a really important lesson, John. You ladder out with someone, an adult like this, and retail's laddering out. Should we go out 10 years or 20 years? Because they're yield hogs and they want to pick up yield. Ms. Jones is laddering 1 to 7. That's a massive lesson right there.
How's that century bond doing?
It's
in
killing.
Austria.
It's just
killing it or killing
it's brutal. It's killing him.
Yeah, I was going to say.
It's just,
It's amazing, at the time when all of that stuff was being issued, when Argentina came to the market, it was one of those moments where everyone knew. Everyone knew. It wasn't like you had that contrarian thought, well, this is a bubble, this is bad. Like, everyone knew it was. They also knew that negative yields was deeply unsustainable. They just got more negative and persisted for a long time, Lisa.
This is when you know something's truly a bubble. When people say maybe it's a bubble that can just exist in perpetuity.
Totally.
And bonds have a new place where it's really capital appreciation and the price appreciation, not the actual coupon, which is nothing.
Yeah, we were going to the bond market for capital returns.
Yeah.
And a monster bond market rally. That yields are negative, great, but they'll be more negative, and prices are going up. That was the story, the last 10 years, Tom.
I mean, it is. I mean, the whole last 10 years, last 16 years.
Kathy Jones, as well. Thank you. It's good to see you. Kathy Jones at Charles Schwab there. If you might just joining the programme, welcome. Counting you down to a Federal Reserve decision a little bit later on this afternoon. Your equity market on the S&P 500 looks a little something like this. We're negative by 0.16%. Looking forward to catching up with Ethan Harris of Bank of America Securities. That would take place at 8:30 Eastern Time, so about 45 minutes from now and change. Tom, we haven't talked about a banking merger that any other month over the last 3 months would have been headline news, top story. And I think it speaks to the moment we're in that we're not talking about the PacWest, Bank of California, or is it Bank of California?
It's bank.
It's
but
bank.
you can call it bonk if you want to sound French.
California.
Somebody,
C for anyone who's not
a
following.
marketing guy had a marketing guy had an extra martini at Bank of California and said, change the K to a C, and we look sensitive if we do.
Do you actually know where that came from? I don't know where that came from.
No,
probably
if someone knows.
It's probably Bancorp.
Oh, is that what it is?
That's probably what it
there
is.
Was a type there.
Yeah, that's my gut.
This is a creative deal. It's got some equity kickers in it for some other people. Warburg Pincus is involved. I really don't know the details and don't care. What I know, John, is pre-crisis, if they come out at $10 per share, I'm just using that as a round number, we're down 80% from the glory times before the blow up. But critically, at the most gloomy, when the Bramocam was visibly shaking over the bank crisis, they're popping up 210% or so, up from 4 to 10. It's a nice rebound off the bottom.
It also highlights how some of the firms that got troubled reputations are having a lot of trouble climbing out of it without some sort of an acquisition.
Dead on.
And that's the issue. So it's going to take private money to come in and fund it.
Creative transactions.
The change now, though, it's their problem, not ours. That's the consensus view, and maybe it becomes everyone else's problem again.
Bonk. Is that the subway stop by Queen Victoria
Bonk.
Street? Bonk?
Yeah, that's what we call it.
Get off at Bonk
You should ask where that is.
Bonk.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
It's really hard to argue against big tech for the time being, but it's also difficult to rationalize the sort of sustainable reaction of the tech market. How big can the big tech grow?
Deepak Puri there, Deutsche Bank International Private Bank CIO. Big tech growing a whole lot bigger through the year so far. A little bit smaller if you're looking at Microsoft this morning. Microsoft at the moment in the pre-market is negative by 3.6%. The AI hopes and dreams, not enough to bail out decelerating cloud revenue growth, which we can talk about in just a moment. Alphabet getting it done. Alphabet positive by 6%. Google up in the pre-market. Ad sales trends look decent over there, Tom. The stock's doing nicely. Meta rising off the back of that initially yesterday in sympathy. Snap doing anything but. I don't know if you've looked at Snap.
I could not believe it. Oh,
brutal.
My God.
If you can get Snap up, take a look at that.
If you can't move socket wrenches off of that, I mean, I looked at it and I just said, inventories in Ohio were terrible there for Snap-on tools. I mean,
down 17%. Snap, not Snap-on tools, Tom. Snapchat.
Oh, okay.
Yeah, different company. Different
this is
stock,
like social media. I've never done Snap.
I was hardly pivoting from.
Should I pivot from
Microsoft to Snap?
Threads to Snap?
You should check it out, Snapchat. I don't even have that on my phone. Yeah.
Lisa, have you ever snapped or whatever
No,
they do?
but the kids do.
You snap.
They love it.
They love it. And the reason why is because they can see where their friends are. And so they stalk each other using the
That's
Snap
so
app
weird.
to find out where people are, ostensibly to hook up and meet up and get a sense of that, to meet up with their friends. But it's also basically, where are they that I'm not? Are they actually there?
And so after
and
that-
they actually track each other, and it becomes a social issue.
And
Are they
then-
all together
That's
without
so
me?
weird.
Yeah.
And then the mother snaps. Is that what happens?
They're come on
like
home.
the-
No,
the
I don't
voice
snap.
changes.
That was really cheesy.
Can I ask a rhetorical question, John? I've never asked this question. Ever.
stop
You know, Mandeep, you see how they don't pay attention to me? It's like I'm not even
We
here.
change the subject every 5 minutes. I've got no idea where
Can
we're
I
going.
ask you a question? Is
Sure.
Boeing a technology company?
Oh, you've done it
Seriously.
just now.
I'm sorry. Boeing is up big. We're talking tech. Boeing is loaded. Those beautiful planes are loaded with technology. They're going to use AI to fly us pretty soon.
Why don't you ask Mandeep Singh that question, whether they're going to use AI? Look, there's actually a real question here underpinning that, which is not somehow going to Boeing earnings, but this question of how are all companies going to be pitching AI as a reason for them as tech companies, especially retailers and others that have a lot of data that they're going to
Fascinating.
use.
Let me cut in. Let me change the subject. Can I do that?
Not the
Okay,
dog.
great. I love our audience. So much smarter than me. That's why I adore you, because they sent me this. The answer is straightforward on Bank with a C versus a K. Okay. At least for Bank of California, the California Financial Code states that in order to conduct business under names that include the word bank with a K, a firm must have received a certificate from the commissioner authorizing it to engage in commercial, industrial, or trust banking businesses. Holding companies like Bank of California own banks but do not themselves operate as one, and so must use the term bank. B-A-N.
That's brilliant.
C.
That's
All right.
brilliant.
That from our colleagues over at BNN Bloomberg. And thank you, sir, on the Bloomberg terminal for
Thank
sending
you.
that.
I learned something.
That link across.
Didn't
There we go.
Bank of
I
Bank of
didn't know
America
that, so that's great.
I didn't either.
We got to get to Mandeep here, and I guess we'll go there, Mandeep. And Lisa brought this up in a call. It's got all this AI BS what we're talking about. Reminds you of nanotechnology, except is Boeing a tech company, and will Boeing be affected by AI?
Well, if they start talking about AI and they start giving numbers, which Microsoft did last night, they told us how much revenue they are generating from these new AI services. 250 million, not a whole lot, but it grew 90% quarter over quarter. And I think the stock is down because expectations were even higher.
Okay,
so look, you can only aggregate the data points. NVIDIA told us they're raising their forecast by 4 billion because of the AI demand. So it just puts it in context.
That's the two people in the heart of it. But if Dan Ives tells us that Microsoft's going to see a 300 beat pop in margin, or Apple, whatever it was, I think we get that. Is Boeing or other companies using technology going to see a margin expansion 3 to 5 years out off of AI?
Probably not, because one thing everyone is realizing is with this wave of AI, you need huge upfront investments in terms of building your data centers, buying these chips, really aggregating a lot of data. And when I say lot, I mean, we're talking about the whole internet, and everyone is getting protective about their data. So I think it will be a handful of players, and it will be mostly tech companies. But the internet companies, I think, are well positioned. And we saw that with Alphabet last night because they have the most data. When you talk about, companies that have digitized everything, it's the internet companies. It's not the Boeings of the world or the Caterpillars. I mean, they are looking to digitize, but they're still very early.
You mentioned investment. How seriously should we take this new role for Ruth Porat, going from CFO to president and CIO? What is that?
I think, it's twofold. One, they want to retain her. Clearly, there is an element of that. And also, in terms of Google looking to take stakes like they did with Anthropic or, new Gen AI companies, they can't buy any company right now with the current setup. So what Microsoft did with OpenAI is they took a $10 billion stake very early on. Maybe Alphabet may do the same, and they already did that with Anthropic. They may be looking to do more of that.
So you think this won't happen organically at some of these firms? They're ultimately going to be small companies that these big beasts, Microsoft and Alphabet, just take stakes in?
I mean, the transformer model on which this whole generative AI is built on was kind of came up from Google. And so it was a 2017 paper that was written by Google employees. The fact that they didn't do anything for the next 5 years, and now we are talking about this wave where OpenAI has become the new buzz, it tells you something that they are slow to change. And that's why these startups will still be nimble. I think Google has the advantage with infrastructure. But clearly, I think the innovation will happen in these startups.
For now, people are looking for where the cash is coming from, and it isn't yet coming from the AI investments. It's coming from advertising more than anything else. And we've seen that divergence really with ad spending delivering and corporate investment in the cloud not delivering. How is that going to color Meta's earnings after the bell? Are we going to see that advertising benefit them as well, the way that we did for Google?
I think some of Google's beat last night was search doing well, but also the cost efficiency side. So you're going to see the same, cost-cutting efforts play out at Meta. They've pared back their investments when it comes to Reality Labs and Metaverse. That will feed into the free cash flow. Alphabet talked extensively about how they are reducing their hiring for the second half. And look, these companies have the incremental margin leverage. So on the ad side, ad spending is coming back, but we saw that with Snap. It's not coming back to the point that it's lifting all the boats.
How long before we start to hear some of the tech companies talk about AI replacing their programmers, actually allowing them to make further job cuts?
Well, look, I think because of the changing nature of, AI and what cloud is doing, you will find certain jobs will get obsolete. And these co-pilots, I mean, what they are doing is essentially replacing people who are just making, small changes that could be repetitive. And that's where co-pilots could be huge in terms of what it could do around, how many tech employees you need, the programmers you need. So that's where I think the co-pilots aspect is huge in terms of what sort of leverage these companies can get, both internally as well as what they could sell to their customers.
Mandeep Singh of Bloomberg Intelligence. Mandeep, this was wonderful. It's fantastic to hear from you, as always. TK, I was listening to a podcast yesterday with the brilliant Sam Rowe, someone you and I both respect and adore. I think he's fantastic. Okay. Yeah. And he was reminding everyone that when it came to the likes of Facebook, they didn't create Instagram, they bought it. When it came to the likes of Alphabet, they didn't create YouTube, they bought it. And what Mandeep's getting at when it comes to AI, what's going to happen here is they're going to invest in things. Now, with the benefit of hindsight, when those deals were made, we look back, I remember thinking, well, that's a lot of money for Instagram. Well, that's a lot of money for WhatsApp. And 10 years later, look at us now. They look like phenomenal deals, and the government's annoyed with themselves for allowing those deals to happen in the first place. And Mandeep, I know you've got to run, but I just wonder whether even the investments of some of these big tech firms now will come under the microscope, knowing down in Washington that these big tech players could get a whole lot larger based on small investments that could be made right here, right now.
They will probably come under the microscope, but I would say they have the scale, and all these small startups need the scale more so now than they did, 5-10 years back, because this is very compute intensive. All the generative AI is compute intensive.
I mean, I look at this. I look at iRobot yesterday on Amazon. We were talking to Carol Masser about it, who's encyclopedic on iRobot vacuuming her living room. I mean, why does Amazon buy iRobot? Why do they do that?
I agree. I think they're not trying to make money off the hardware. They're really trying to. Yes, it's a technology.
They wanted the floor plan in our rooms and stuff like that.
Carol Masser's
that's what it's about.
Carol Masser's at lunch downtown. We get her on the phone with Paul Sweeney, and Carol Masser's encyclopedic on vacuuming your house with these robots.
They want to understand how big your room is.
Do you have one of those?
No, I do not. Not giving away that data.
Alicia Levine going to ride it.
Of BNY Mellon. Up next from New York, this is Bloomberg.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute, and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
News breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI, semi sort of trade here.
The $69 billion deal is the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Inflation remains well above our longer run goal of 2%.
We're likely to need a couple more rate hikes over the course of this year to really bring inflation back.
It can take some time and assess and collect more information and then be able to act.
I do believe that underlying inflation is declining gradually and in a way that may well be sustainable.
I would say we're close, but we still have a bit of work to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Right. Good morning, everyone. This is Bloomberg Surveillance on radio and television. Fed Day. Thrilled you're with us. Lisa Abramowitz has returned off Norway, Svalbard, wherever that is, looking at whales and the rest of it. Lisa, nice of you to show up for Fed Day. Jonathan Farrow is always here as well. That was the best opening of the 8 o'clock hour I've seen in years. John, what a bunch of hot air. They were wrong 6 months ago. They were wrong 12 months ago. They were wrong 18 months ago. And Ben Bernanke, Ethan Harris, writing Ben Bernanke's Fed, would say they've been wrong since McChesney Martin.
It's nice to see you fired up and engaged because last
What a
week you were
bunch of hot air.
declaring, you were talking about a victory lap at the FOMC only a week ago.
They can have a victory lap in real time based on data, but this crystal ball gazing, the dots. I had dinner once with Richard Berner, iconic at Morgan Stanley, and we were talking about, you know, you had Arthur Burns smoke signals, you had Greenspan, what was a sandwich at lunch? That's more sophisticated than we just heard in the show opening.
Well, Bernanke unleashed maximum transparency coming out of the financial crisis, and Tom, once the toothpaste is out of the tube, you can't get it back in, and this is what we live with now.
Important question. Does the Bank of England have maximum transparency as a young institution? They're still feeling their way through that.
I don't get the same sense that those officials are running around doing speeches with quite the frequency that I see from officials on the FOMC. I think the ECB's up there. Hear from the ECB and President Lagarde all the time. In fact, I think you hear from President Lagarde more than you hear from Chairman Powell.
On the lawn at Frankfurt years ago, I was like, who the hell is that? It's young Farrow. the young lad on the lawn at Frankfurt. The ECB tomorrow is a changed institution. There's massive challenges there of Bundesbank, hawk-like, versus others going, you got to be kidding me.
Well, you mentioned the Bundesbank. Germany's in recession. So I don't think the decision for them is that straightforward either. And what's been interesting for me over the last couple of weeks is not to listen to the doves. It's the perceived hawks on the Governing Council who won't commit to tightening beyond July. So you get a hike at this meeting potentially on Thursday, but Germany's in recession, the PMIs are dreadful, business confidence isn't great, and inflation's still a problem. Now, is that a lesson, a case study for what we might experience stateside? I don't know, but it's pretty fascinating this Thursday.
Clear the mind. She did what I've never done. She saw orca whales or something off Greenland. Very cool. Lisa Abramowitz, you've had your mind cleared here the last X number of days. What's the toxic brew that we're going to see at 2:30 today?
Well, I love your setup, by the way, for Fed Day. Your tease ahead. They've been wrong forever. All these smoke leaves. It's ridiculous.
Like
Watch us. We're going to be on at 1:30.
I prefer the way it used to be.
Okay, fair enough. However, they were dominating and keeping their thumb on the market for more than a decade. It was the Fed's market. It was the Fed's bubble. It was the Fed's Austrian 100-year bond, as well as all the other central banks. How do they communicate what that new normal is? And increasingly, that's the focus. How long are they going to keep rates at the highest level going back to 2001? How long can they basically say, even if we don't get a recession, we can cut rates if we see some sort of significant slowdown in inflation?
They're data dependent, and to me, your wheelhouse, Lisa, is a key data dependency as we're pricing bonds to perfection. The jargon here, folks, is spreads come in. Have you seen any wavering in that into this Fed meeting?
Spreads are the tightest on high-yield bonds, the extra yield over benchmark rates, the least going back to April of last year. Question is, how much is this a legitimate reflection of a lack of defaults or a perceived lack of defaults in the same way that we've seen traditionally in downturns? And how much is this a mispricing as people look for risk in every corner?
Off the radar, John, I'm looking at Brent crude rounded up, $83. That's not $79.
Let's get into the cross-asset check. Equities this morning on the S&P 500 shaping up as follows, negative by 0.16%. Microsoft, disappointing, a deceleration in cloud revenue growth. That stock in the pre-market is negative by about 3.65%. The story for Alphabet, that stock in the pre-market is positive, 6 percentage points. Ad sales, pretty decent. Looking ahead to Meta after the close. Maybe want to watch after the Fed decision later on this afternoon. Tom, your 10-year, 388.66, yields basically unchanged going into that.
Everybody's got a different act on Wall Street. Alicia Levine is head of investment strategy and equity advisory solutions at BNY Mellon, and what she does differently, the distinction is she brings prodigious dynamics and mathematical abilities to the show. What's the interesting thing in the left tail, Taleb's huge risk, the black swan out there, in the right tail, which is where the Dow up 47 days in a row is? Tell me about the tail distribution right now if everybody's loving the Dow Jones Industrial Average.
Look, the tail distribution is enormous here, but a little bit shallow, meaning that the left tail has slowly shrunk, but still bad, and the right tail has moved out further and a little bit fatter, and that's what you see in the market. It's very hard to say we're not going to end in a place where the Fed just keeps on breaking something. Hard to say that, but on the other hand, the evidence so far, just look at housing yesterday, Case-Shiller, like housing, if that's the leading indicator of where the economy is going and the transmission of Fed policy, we've bottomed. So how can we bottom with the Fed at 525 here?
Right. So on a partial differential basis, how do you reallocate on 60-40?
So look, we do think ultimately there is a recession out there, but there's always a recession out there. Like we're in a business cycle. So we think that you're going out a little bit more on duration, although I do think there's risk to over 4% here if the economy stays strong and the Fed may have to relook at its path and its dots. And we never went underweight equities. We always stayed fully invested. I remember sitting here a few months ago and you said, how do you not go 5% cash? And I said, well, we don't do that in our client portfolios. We're always invested. And so our clients have taken advantage of this upswing because in the end, you can't time the market. And with better than expected data, when all of Wall Street was expecting the apocalypse, this is what you get. You get the melt up. And now it's moving into other sectors.
Exactly. And so many people missed that tech melt up, and now they're wondering if they're going to miss the melt up in cyclicals as well. So discuss that broadening out we've seen in the equity market, please.
Look, the really interesting thing is really since the beginning of June when we had that blowout labor report, right, which came in much better than expected. All of a sudden, you saw a switch in the market. You saw the broadening out into the cyclicals. There was a recession trade there in the stock market, and the recession trade was buy tech, large cap tech, because they can fund themselves. They've got this great new shiny toy. They've got cash flow, and they don't have to borrow money. So that's terrific. And they don't trade on dividend yield because there are no dividends, so it's all fine. And the rest of the market really was terrible, particularly the deep cyclicals, the banks and energy, and the small cap. And what you saw in June was a switch. And all of a sudden you see it broadening out. And now you've got, a greater percentage of the S&P trading above the 50-day moving average. You've healed the market technically in many ways. And so there are other ways to make money. I just look at the industrial reporting from yesterday. How do you have industrials beating estimates in a recession?
Well, but this raises a question that Max Kettner was talking about, as well as Francis Donald. There is a question about whether people are buying into disinflation prematurely and whether the underbelly of this immaculate disinflation is sticky inflation and stagflation down the line. How much is that a preeminent concern of yours?
So it is a concern. I think the world we're in is a higher inflationary world. The thought that the Fed can get to 2% and stick that without a downturn seems difficult, because if you just look at what's going on in the labor market, that seems to be the sticking point. We think inflation remains slightly higher through the next cycle. And the question is, does the Fed accept victory at 3%? That's the big question. That's the difference between good probability of a soft landing versus we're going into something really breaking. Is that 2 versus 3%? And does the Fed lose credibility if it accepts 3%?
As an asset allocator in that kind of world, are stocks better than bonds?
Interesting question. So we are more allocated to stocks than bonds right now, but we also have increased our allocation to alternatives, particularly as we're disintermediating the banks from certain types of lending. So we really try to go across all the asset classes to take advantage of the world we're in. We think the world we're in ends with higher Fed funds rate than from before. The thought that we go back to zero is a pipe dream. I think the excesses from that period are clear to all central bankers here. So absent a major crisis, we're not going back to zero. 3 to 3.5 feels like the right number on Fed funds, and that's just a very different world and a very different way to allocate as well.
What's the Levine rationalization of owning, holding, acquiring the successful tech stocks right now? Do you rationalize and move out your terminal rate where you say, I'm buying out 3 years, 5 years? What's the process you have to keep those stocks in a portfolio?
So we don't trade, and the rationale is always the long term. So
yeah, but long term, come on, this show the long term 6 months. Continue.
True. End of year. 3 to 5 years is the way you buy these. You buy these because there is an acceleration of growth in a new business model that will be monetized going forward. Yields will be lower on all likelihood 2 years from now. Then you get the multiple taken care of. You don't worry about a cap on multiples, and that's how you buy them here. That there's a massive growth opportunity ahead of them. The AI creators and the beneficiaries seem to be centered in large cap tech, and that's where you have to go to take advantage of it.
People find this so hard. Shut your eyes, hold your nose, and buy something that's already up 100% this year. Alicia, what do you tell them?
I'd say look at 1995. That's how you do it. Right. I mean, that was one of the greatest explosions of wealth in the stock market, and it was a great time to be picking stocks. But that's really what you have to look at. This is not going to be a short-term story. I mean, of course, there's going to be drawdowns. We haven't had a drawdown this year more than 8%. In the midst of, the Fed breaking some regional banks,
it's amazing.
We sold off 8%. The average is 15%, their average drawdown for the year. So would we like to see that? Of course we'd like to see that so we can, buy more. But... So it's been a really unusual year, and I think the thought of positioning and everybody on one side of the trade is a great reminder when everybody agrees we have to be really careful.
Alicia Levine of BNY Mellon. Alicia, thank you. Heading up wealth management over there, TK, some important lessons, market history of the last 25 years.
What's the lesson in the weekend on the rationalization of bonds and to be bears rather, and to be fair, the rationalization of bulls here? I think there's just we laugh about it with Lisa, the toxic brew. It is a toxic brew of emotion over what was missed since October of last year.
And I'm with you, Tom. I can't get out 2-3 years. Can't get out 6 months, can't get out 24 hours. Chairman Powell, just around the corner from New York. Welcome to the program. If you are just tuning, you're S&P 500. If you are just tuning in, we are negative by 0.2%. Coming up in about 28 minutes' time, the brilliant Ethan Harris of Bank of America on the Federal Reserve, Tom, the ECB on Thursday, and the Bank of Japan to close out the week.
Well, it's important. The three central banks here, and of course, Dr. Harris, iconic across modern economics. I believe he's going to enjoy a retirement, probably writing a new book and thinking maybe he'll fish out of Jackson Hole. He and Brammo can go out canoeing across the lake or whatever.
Brammo went canoeing last summer.
She did.
Yeah, I know.
God, you guys didn't even venture out of the
invited me to
cafe.
come. I was like, I'm not going anywhere with those bears.
Oh, my
That
goodness.
is not happening.
I said, do they have floaties? And she said, Tom, they don't have floaties. And I said,
do you use floaties to swim?
No, but canoes. I hate canoes and kayaks. I don't swim. Can you see me swimming?
No, I don't know, Tom.
Can you see? Come on. Can you see me off 3 islands?
You don't swim.
Can you see me off?
Can you not swim?
No. Can you see me off 3 islands in Italy in a Speedo? It's not going to work. I mean, John, don't go there.
Hey, I don't wear a Speedo.
Breakfast
don't
time.
Although I did notice that more and more people at the beach are wearing
Europe.
Speedos.
In
What's that
Europe.
about? No, these people are from Australia.
Okay, but they're not
I'm telling
American.
you.
I've not seen
I'm telling you.
Speedos.
Australia.
I saw that.
ever since
I don't know if they thought that
1950.
other Italians were doing that, but I don't know what.
We covered it all.
I've got thoughts on that.
Devin, I liked it. Australians
Look
are
at that,
from
we're out of
Europe.
time.
I learned something today.
Australians. Yeah, there were. I'm telling you. I'm telling you.
Did you go up and ask them?
I didn't talk to them about it. I just heard the accent. I was like, oh.
Connection lost.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities.
We could face bigger challenges next.
Fed was going to keep rate while
This is a 3.
As the economic picture does.
The OK is getting ready to make.
The market expects another rate hike.
They're getting the message loud and clear. The Fed wants to go again.
The then what is the big mystery.
But will it be the last of the cycle?
Is it one and done or more to come? Does the Fed make policy based on what they're worried about or what they actually see?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Twice more is not too high of a bar.
The Fed wants all options on the table.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
The good news is there's not going to be a recession this year. The bad news is it's still coming. And I think we're in for a big productivity ride once we get through this next downturn. If I had to put potential growth 10 years from now, I'd probably put it closer to 3 than 2.5.
Good morning, everyone. It is Fed Day right now. A lot of news flow going on. That was my interview of the week, no question about it, with a banner headline off Drew T. Mattis, MetLife Investment, where he's looking at a 3% GDP model out. Shocking optimism from a measured and conservative and very competent strategist as well. We're going to get to this in a moment. Here, staggering in front of you, Ethan Harris will join us from Bank of America. And, of course, we're getting ready for the Fed Decides. And today, after the Fed Decides, Bremo off Norway is yet to see Barbie. I've seen it twice. And so we're going to go a third time because Mattel's lighting it up if anybody will stay around long enough to get a paycheck.
So basically the news just dropping, Dow Jones reporting the Gap has hired the Mattel executive who revived Barbie to be the new Gap CEO. You're seeing Gap shares popping in pre-market trading up almost 6% as they do make this acquisition. What is the Barbie trend going to say about the Gap style? I'm just curious. I'm just going to throw that out there.
That was the first thought I had was, okay, how does he Barbie-ize Gap?
Barbie-ize.
You know, beige is really big here. I mean, that's Gap, right?
Well, right. So how do you go back to basics, or do you come with some sort of style? Richard Dixon, the Mattel president and COO, is going to head over to the Gap to be the next chief executive officer. This comes after a year-long search for a new leader. Tom, I thought this was interesting given what we've been talking about with, what was it called again? The sort of movie cycle, but Barbie was like the top.
Yeah, well, you missed all that. You know, it's not. What's interesting is we're not over Barbie, and no pun intended, and maybe it's an HR violation, but does Barbie have legs? And I mean, that's seriously the emotion this morning. Ginormous weekend. Shh. Thank you. It's a Zildjian symbol. But it's an enormous weekend. Okay, great. Why does this thing not? I just think they keep doing it. People are. I remember years ago. This is pre-VCR. You went to Mary Poppins 10 times. You went to Sound of Music, 8 times. Why are people not going to go to Barbie 5 times? I would suggest possible.
How many times have you seen it?
Twice already.
All right.
Yeah, it's good. I like Beach Ken. That's sort of the best part of the movie.
That's the vibe you're going for?
Yeah, I went with the beige suit today into Fed Day, and we'll do that. We'll get back on the tracks here right now, if we can, with futures at -8. Yield market, I'm going to call some stasis. Perfect time to talk to Ira Jersey about this Fed meeting and about yields out. Chief U.S. interest rate strategist, Bloomberg Intelligence. Ira, on a cut to the chase, Drew Mattis stopped the show by modeling out a more optimistic real GDP framework. If yields come up into some form of American exceptionalism, American enthusiasm, there seems to be a consensus view we're all going to die. Do we survive a higher real yield? Do we survive measurably higher nominal yields?
So you asked 2 different questions there, right? Because you asked about nominal yields and real yields, which are going to be 2 distinct items, I think, going forward. So number one is, I think that can we survive higher real yields? And the answer is, the economy probably can't, right? So I think with 5-year real yields, a little bit below 2% right now, that's suggesting that there is a risk premium built into the market. And once you have a recession, whenever that tends to be, I think it's probably not until later next year. So Drew's 3% real GDP forecast for 2024 is pretty optimistic, I think. But if it does come into fruition, we probably need real yields to be pretty close to where they are, if not even a little higher. So it really depends on, do you think that there's fragilities in the economy that are going to force us into a recession, and therefore the Fed to ease, which is my view, or not? And if we're wrong and say, my friend Drew is right, we wind up with a situation where yields stay where they are. You wind up continuing to have a very inverted yield curve, and we never see a recession.
Ira's just calling Drew my friend because Drew has tickets to the World Cup coming up in a year and a half. Ira's like trying to see, Brazil play Argentina.
You're on this whole insider trading kick, right? That's exactly what we're talking about here. Oh, yeah. We've got the full allegiance over there. Ira, I do want to build on what you're saying. You're talking about how you could, if there is this sort of lack of a disinflation or disinflation head fake, you could see yields and real yields go even higher than where we are now. Does the chance of that seem more likely to you based on some of the housing indications and others, the resilience in an economy that supposedly should be battered by rates at the highest levels going back, to 2001?
Well, So it's a real challenge to actually forecast this market and where we're going. And that's been true since the pandemic, really, because we've seen, different shifts to various parts of the economy, everything from the supply chain issues we saw to now extremely tight labor markets that we didn't expect. Look, I fully admit I didn't expect inflation to be as sticky as it has been, primarily, and this is going back to 2021, a couple of years ago, primarily because we didn't expect the labor market to be so tight and for labor to have pricing power. Now, the question is labor going to have pricing power going forward? People aren't going to switch their jobs every year to go get big raises, which is basically what's been happening in a lot of industries. And if that's not the case, then inflation is naturally going to come down to more sustainable levels.
Which is the reason why, and you were talking about how you got it wrong in terms of the stickiness of inflation. A lot of people did, including the Federal Reserve, by the way. It raises a question about whether models are broken. And there's been a real debate over yield curve sort of prophecy and whether it is no longer the tool that it used to be for forecasting. Do you buy that argument?
So all the yield curve is all it is the market's expectation of where short-term interest rates are going to be in the long term, right? And at some point, the Federal Reserve is going to lower interest rates. There's almost no doubt about that. The question is by how much, how long, how fast will they do it? When will they start? So the idea that the Fed's going to hike one more time and then start to cut in 6 months, maybe that's where the market's got things wrong. But is the 10-year necessarily mispriced? No, because the Federal Reserve might cut more later, right? So there could be an environment where the Fed stays at 5.5% for, say, 18 months because we have sticky inflation, because all of our models are broken and we don't really know what's going on. And then suddenly something breaks, more banks maybe, or maybe over-levered companies start to fail. Once that happens, the Federal Reserve winds up cutting interest rates very aggressively and maybe down to, say, 2%. Well, if you do all that math and you say, okay, what's fair value for the 10-year in that scenario, we're perfectly priced for that. So there's multiple scenarios that the market's pricing, but all we're saying, all the market's saying is rates will be lower 3-4 years from now than they are today.
The vanilla spread is a difference in yield between the 2-year yield and the 10-year yield. We quote it, and I would say, what do you think, 8% of our audience gets it? The rest are like, what the hell is he talking about?
It's generous.
You're the pro. Which of 45 spreads out there matters to Ira Jersey? 2s, 10s, 3 months, 30 years, the 2-5 belly of the curve, way out in the curve, 10s, 30s dynamics. Which spread matters to Ira Jersey?
Yeah, so the two that I look at is the 2s, 10s curve, and primarily because that has tended to be where markets tend to be the most liquid and where you get the best indication of what the market's really thinking for future economic activity and inflation dynamics. But also for me, for the real economy, one of the spreads that I look at quite a lot, and this has kind of broken this cycle, and it never has before in any other cycle since World War II, is the Fed funds 5-year spread. And the reason is that tends to show where bank net interest margins are and creates the willingness for banks to lend short, right? So basically take in deposits and then lend in 5 years, right? For auto loans or the average of some real estate loans and the like. And if banks aren't making money from making those loans, that's going to contract.
What's the duration of the Fed funds? I mean, I get 3 months, I get T-bill.
It's basically zero. So
Fed funds is like tomorrow.
Right, correct. And
so there's a spread from tomorrow out to 5 years or whatever.
Correct, that's right.
Every time he's on, I learn something. I mean, Bram was like snoozing Tom, you dummy. You should know this stuff.
No, this is all important, and honestly, the bond dynamics are going to rule so much of the next cycle, or they were supposed to anyway, when this was an economy that was interest rate sensitive.
Ira Jersey with us from Bloomberg Intelligence. Much coming up, much to talk about here on a Fed Day. We're with you this afternoon. Good morning.
News and climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
The ECB is still catching up.
They want to hike and show strength when they actually should show caution.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Are we at the end game for the ECB?
Those questions will persist up until Lagarde goes on that podium.
Coverage begins Thursday on Bloomberg, your global business authority.
Bloomberg Surveillance. Good morning, everyone. Fed decides. We'll be here this afternoon, 1:30. We start. It's like you know, baseball, football, whatever. We start a half hour early. You know, well, I think he's been pitching well. You know, I like the way he's been seeing the ball. We do that kind of thing for 30 minutes.
We saw him walking into the meeting, and he just seemed to have real confidence.
Look, just standing tall. Bill Dudley will be with us. Bill Dudley, New York Fed president, and it's good to have Dr. Dudley with us of Berkeley and Goldman Sachs and all that, Lisa, because Dr. Dudley really makes a case for vigilance about inflation.
And that's what we've been hearing today as well from people who are in the market, that now the concern is not recession. The concern is stagflation. The concern is no landing, although slow growth and inflation that remains high.
We'll be here, and you know, I get it. It's a quiet meeting. We've already decided this. There's no dots to display. Michael McKee will be in the press conference, but I usually my radar's up, folks, because the quiet meetings can be the more silent surprises that come along in a given statement as well. Futures -8, Dow futures -67. This is joy, and I'm going to cut to the chase of what Ethan Harris really did. There was a small shop that went under. It was called Lehman Brothers, and he was one of a select few that provided immense stability to Lehman Brothers and the debris. After that, he migrated over to Bank of America Merrill Lynch, where he's been a force for decades, and he's retiring here. I'm going to cut to the chase. Is Moynihan aware of this? Because Brian comes on Bloomberg. Well, I really think real GDP is going to do this, and he's looking down at Ethan Harris and stuff. Did Moynihan allow this?
Yeah, he's allowing it. You know, one of the great things about our CEO is that he does read our stuff, and he really cares about his research department. So I'm going to miss that. I mean, one of the great things about working at B of A is that the firm really cares about research.
I've been busting. He's selling this like, you know, it's just great. Brian, you can't come out in front of the camera. Stay over there, Brian. What's important here is you wrote a magnificent book years ago, Ben Bernanke's Fed, that was a piercing book with your experience at the Fed about the dynamics of the Fed. What does Jerome Powell's Fed look like as you go to write your next book?
Yeah, so I am going to finally write that next book you've been asking me about for 15 years. You know, I think what we're going to see is a turning back the clock. I think the experiment that the Fed did with this 2020 new framework didn't work. And we're going to see a turning back of the clock to something that looks more like a Ben Bernanke or a Janet Yellen Fed. I don't think it makes sense for the Fed to do what they did, which is wait to the last second, wait for inflation to be really underway, and then start to hike interest rates. So I don't expect radical change, but rather kind of just go back to the old model.
Well, the old model, is it the old model meaning 10 years ago, or is it the old model 40 years ago, which was very different? And that's really the big debate we've been hearing about. What's your view of how we're going to look back at this moment in history? Was it a sea change that ushered in a new era of high inflation, or was it a pandemic-induced blip that's going to go back to what we were seeing 5 years ago?
Well, I think the Fed has demonstrated that they learned a lesson here. They started very late, and you'll hear that from Bill Dudley later today. He was one of the people arguing they should get moving. And they started too late, and then they did an incredibly aggressive catching up. And that was a signal to me that they understood that they'd made a mistake. Because you don't want to be going 75 basis points a meeting. It's very dangerous normally. But if you're way behind the curve, you catch up. So I don't agree with people who say they're going to compromise on their inflation target. At his press conference, he repeats over and over and over again. Every chance he gets, he says, we're serious about hitting our 2% inflation target. He's putting his credibility on the line. He does not want to be Arthur Burns. He wants to be Paul Volcker.
What have we learned, though, about this aggressive tightening? You're saying they don't want to do that. They did that. Nothing broke. You could argue, okay, we saw some bank rumbles, but right now we're looking at housing reaccelerating, seeming to have already bottomed, and much of the economy performing better than expected. What do you make of that?
Well, I think that they were up against some very big tailwinds in the economy. You had all that massive excess saving left over from the fiscal stimulus during the crisis. You've had pent-up demand for workers with all these job openings. And so the Fed did achieve some weakening in parts of the economy that are interest sensitive, but the consumer just refused to roll over. You know, jobs were great, their savings were high, and they could spend their savings. So I think it's delayed the weakness, and we still think a mild recession, probably early next year. But like a lot of other forecasters, we've been forced to concede that it's not here. It's going to take a while. I don't think it's the end of the world. There's this hard landing, soft landing debate. Come on, if you're forecasting the unemployment rate going from 3.5 to 4.5, that's not a hard landing. That's great. That's normal unemployment. Yeah. So it's the people I disagree with are the perfect landing crowd that says, oh, you don't have to have any pain at all, that inflation's going to go away on its own, no adjustment in the economy. That I disagree with. But it's going to be a soft landing, either bumpy or a little more bumpy, but it's not going to be a hard landing.
With our new data capture, with all the noise that's out there, is there too much communication? We opened the show with a beautiful vignette one of our interns put together of all these Fed speakers speaking. Is there too much communication?
Well, I mean, that's the structure of the Fed, right? It's a very...
Not the old Fed.
Well, when Greenspan dominated, he suppressed the rest of the committee's openness, and so that's changed under the new Fed chairs. So there's a lot of information coming out. I think the business reporters are a bit too hyped up about this whole thing. They keep talking about hawks and doves and all that.
Hawkish pause.
Yeah. Well, look at the Fed. There's been virtually no dissents through a period of way behind the curve, fastest tightening in history, and now data dependent. Nobody's dissenting.
Right.
So the idea that you need to get all pumped up about what some dove said or what some hawk said, I think is way overdone.
You have been prodigious in building careers. I mean, what you did for Michelle Myers, she went off to some charge card company to, I don't know what she was thinking. Moynihan's, you have to recover from Michelle Meyer leaving. But the bottom line is you've built careers. You came out of the Newtonian calculus at Clark University up in Massachusetts. The idea here of math that matters. Is there too much math now in the game?
Well, not in the part of the area I'm in, right? If you're a Fed economist or a street economist and you're trying to figure out the economy and policy, we all understand that it's a lot of storytelling and historic analogy that you don't want to get too crazy about the modeling. Yeah. In academia, there has been this drift into mathiness where you impress people by the complexity of the model. Yeah. But it doesn't really work in the real world. So there's become a split in the economics profession between people who are practical economists and the ones that do the mathiness.
We're speaking with Ethan Harris of Bank of America Securities after more than a decade at Bank of America, who is retiring as of this Friday, I believe. I believe this is your last interview that has been scheduled, and we appreciate you sharing it with us. I want to pivot a little bit because we're talking about looking back over a trajectory of a career and understanding where we are at this moment. Do you think that in the future, people coming into this industry will be working in an office to the same degree? Do you think that that will be one of the big sea changes that persists over the next decades?
Well, I think to some degree, hybrid is the new normal. I think there's a battle going on between corporate leadership and the staff about whether that's really what they want to do.
Harris getting himself into trouble. He's on the 2-day countdown, and
maybe
HR's compliance is like, what's he saying?
Yeah, so maybe today is my last day. No, I'm not talking about Bank of America. I'm talking about in general, and there's a trade-off, right? So it's definitely not good for developing new people to have everyone sitting in their pajamas at home. That's not a good
May we quote you on that?
Yeah, exactly. If they don't have their pajamas on, then you're really in trouble. But anyways, so you don't want to be entirely at home. On the other hand, in my case, I have a crazy New York City suburb commute. And so for me, I'm more productive if I'm working hybrid. So that's really the debate. It's about, what's the most productive model? And I think in many industries, hybrid is going to end up being the thing.
A sensitive question as we talk about some of the earnings of tech companies and artificial intelligence. Is ChatGPT going to be your new research assistant?
I tried it. And in fact, a friend of my son tried it out, and he put my name in there and started asking questions about me. Now, I've got a lot of visibility in the press and stuff. What I found with the chat app is that at first it gave very good answers. It found my bio and wrote it up in better language than I did. But then as my son's friend kept asking tougher questions, it started returning nonsense. It started telling me that I'd won some great prize in Japan for there's some like, it's like a peace prize or something in Japan. And so if you pushed it and tried to get it to get really interesting, it gave you junk.
I've got to ask you this because it's the heritage. Can you give all of our Global Wall Street audience a vignette of what it was like, not the final days of Lehman, but a week after Lehman, a month after Lehman? Give us a window and how you and others had the leadership there to pick up the pieces.
Well, I mean, everyone was in shell shock, I was lucky. My team got picked up by Barclays, and so we had a life raft, lifeboat to jump into. But you were kind of in this environment where you had both these forced marriages going on in Wall Street, which are never fun, at the same time that you have this incredibly demanding and interesting and challenging world you're trying to forecast, where the economy is just collapsing. And it was an amazing time, and you just had to kind of, lean on each other a bit, I guess.
Ethan Harris, thank you so much with a huge commitment to the show. It's just been great.
Thank you so much for being with us. We really appreciate it.
It's been great. I hope it's not my last time on.
Can you give this box here? Can you come on, or give this to Brian? Okay, he's tearing up behind the camera.
You guys are really trying to get me into trouble.
Brian, contain it. Okay, he'll still talk to you. It's amazing that we bust people's chops, Lisa, about this, and we can talk about this. I mean, these CEOs come out and they're under the gun. And some are informed and some are not. Mr. Moynihan, always informed. We're going to inform Brian Moynihan right now. Standard & Poor's 500 down 0.2%.
If you're just joining the program now, coming up, we will be speaking with Sean O'Brien, General President of the International Brotherhood of Teamsters. And Tom, this to me comes at a real tension point where people don't understand the dynamic in the labor market. Labor has gotten an upper hand in a way that they haven't had for decades. And this comes as it's a victory for certainly the Teamsters, UPS to some degree, and also Joe Biden.
This could be a one-hour conversation. It comes off of John Farrell's great work with Marty Walsh, as well as Secretary of Labor, former mayor of Boston. But it's dragging a truly American institution, the Teamsters, with all of the debates. We don't need to get into that with Mr. O'Brien, forward into the modern age and the symbolism of this UPS deal. And I'm sure he'll sell us on what's beyond it. but it's a huge moment for organized labor going well past the 1930s.
Yeah, and some 340,000 members. This is not an insignificant thing. I'm curious about the details because, yes, you do have the Teamsters saying that UPS blinked. When you have this kind of messaging,
well,
you do wonder what the actual concessions were on all sides. I think something like $30 billion extra given to the members. Yeah. What is the new paradigm for labor negotiations?
With a new paradigm here, and the question is, does labor finally get a share? I mean, Ethan Harris, Lehman and Barclays and on the Bank of America can remember when labor had some form of power, and they gave that up for whatever events off of 2007, 2008.
And corporate profits as a share of the overall pool increased. Do we see a reversion of that, or is this just a very small adjustment at a time of distortion?
We're going to continue. It is Fed Day, but coming up, this important interview with the head of Teamsters from Local 25 in Boston to changing the labor economy of America, Sean O'Brien. We'll do that next. Stay with us. This is Bloomberg Surveillance.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Fair contract is one that the members are going to ratify. So a fair contract is something that that workers choose at the end of the day. And again, that process is important for the parties to be able to negotiate, to be able to stay at the bargaining table, and to be able to resolve issues that we want stable work. We want a path to the middle class. We want security in retirement. We want health benefits. We want leave. Those are all things that the president has prioritized. And I think those are all elements of what it means to have a good job.
30 days ago, the acting Secretary of Labor, Julie Su, there on a jobs report and talking about labor in America. We're going to get to that in a moment. With Sean O'Brien, who is General President of the International Brotherhood in Teamsters. We've got a Fed meeting coming up here this afternoon. We're watching the markets as well. We're going to get some movers done here as well. You want to do movers now or later?
I think this is too important.
Yeah, I think this is too important. We're going to do movers later, even though we're in the heart of earnings season. We could go for an hour, frankly, on this. This is the conversation of the day. If you are in Local 25 in Boston and you grew up with 3 generations of Teamsters, and then you take on all of what we know, all of the decades and decades of history of the Teamsters, and you revolutionize unions in America, you come to a moment like we saw yesterday with Big Brown UPS. Sean O'Brien has provided the leadership on this. He's General President of the International Brotherhood of Teamsters and joins us this morning. Sean, congratulations on this pre-vote agreement, this handshake agreement you have with UPS. In your comments and others, You say Amazon is next. Where do you move from the successful agreement to the next transportation company? Is it Amazon? Well, we've got some audio problems there with Sean O'Brien. We'll come back here in a moment. Lisa, I think this is just so important, and my sophisticated observation is driving north on 3rd Avenue at any given time of day, where the trucks of the Teamsters are lined up on 3rd Avenues delivering all those boxes to our building.
When you talk about Amazon, are they the next one? I'll give you some sense of the details of this agreement. There was a wage increase. Existing full and part-time UPS Teamsters will get $2.75 more per hour this year, and $7.50 over the tenor of this contract that goes to 2028. So if you think about where we are in terms of the wage increases, what is the new minimum wage? Not dictated by the government, but dictated by workers who are needed more than ever on the front lines of some of these roles.
And out of the railway strike, there were things in here that I thought were almost commonsensical, like a discussion of what to do with Martin Luther King Day, MLK Day in January, where the Teamsters get to rest with everyone else, including us, to things that you can really see are within negotiation of the defining of part-time and full-time workers in the 7 shades of gray. I'm making that up, folks, the 7 shades of gray between that. This is heated debate.
And it also comes at a time where people are wondering how much longer the labor power can really continue. Just some more details. I'm working through some of the details, and it really highlights how differently we can look at some of these roles. UPS delivery drivers, just to give you a sense of how much they're paid per hour, $49. That is the top rate, $49 per hour. That is the highest paid delivery truck drivers among all of the ones in the United States. Does this set a new low mark for all of the other companies? To your point about what does it say for Amazon, that's been also raising wages
to keep up. What's so
important
important here, and we've had some technical difficulties with Mr. O'Brien, we're trying to pick that up again. We'll see if we do that. Perhaps Bloomberg will speak to Sean O'Brien here later in the day, if we can redo that. But Lisa, what I would mention here is the idea of the generational change. There are stereotypes of all these organizations in the government, outside, and someone like Sean O'Brien has blown that up. Just read his Wikipedia, but forget about that. Read the literature on what this kid out of Boston did, and there's a modernity to our union discussion now, and you wonder where that's going to come. We're going to try to pick it up here now with Mr. O'Brien here with not enough time left, but we'll go there. Sean, again, congratulations on this. If I look at UPS and I move forward, is Amazon your next company to speak to?
Amazon is definitely going to be a target to organize. We're going to take this historic agreement and use it as a template to show the Amazon workers what they will receive when they join the Teamsters Union, and we organize them.
The significance of this agreement speaks to a new Teamsters. Does all of America, including, I'm going to call capitalist America, misunderstand the modern labor dynamic?
Well, I'm not sure if they misunderstand it, but the one thing that we were able to achieve with this agreement is that we showed the entire country what you can do when you have the support of your rank and file members. I think we put some more energy into the labor movement, but also we got the largest deal done without having to strike the company. So I think we added credibility to the process, and also more importantly, we set the tone for what organized labor can achieve against corporate America and these high profits, and we want to be rewarded. Our members need to be rewarded.
Sean, you said that UPS blinked. Do you get the sense that corporations are more willing to blink now because of the labor shortages, that your negotiating power is stronger than it's been in a very long time?
Yeah, I think we've got tremendous leverage right now because we can leverage our ability. We've provided tremendous support during the pandemic, providing goods and services. And I think now it's the time to capitalize. I mean, far too long, we kept seeing CEO pay increasing and stock options increasing, and our members' pay, not just in the Teamsters Union, but throughout the labor movement, were not increasing. So I think right now we have the ability to really showcase and be the model and encourage other unions to stand up and fight.
How do you decide, Sean, when you're negotiating what the threshold is between workers' rights and workers' pay increases versus the health of a company, of what's sustainable over a longer period of time, given that prices are increasing and this is an inflationary environment?
Well, I think first off, I mean, we had a great situation here with UPS because of our members and their hard work. They made $100 billion. So a healthy company should share the profits and should share the wealth. Look, we take every negotiation. We do a deep dive. We're a lot more sophisticated than we were 30 or 40 years ago. So we obviously study the finances, study the projections, and make certain that, you know, we understand what we can get out of these companies. But, you know, far too long, you know, everybody uses the economy saying, hey, we could probably go into a recession. And that's all well and good. We always come out of bad situations at some point in time. So we always just stay focused on what our members need. We're not too concerned about Wall Street or anything else. What is going to help our members survive and provide middle-class opportunities for their families.
Mr. O'Brien, in the time that we have left, I mean, your sons are involved in this. Your father was Local 25 as well. You've lived this for your entire lifetime. How do we change the atomization of labor in America, the deunionization of America? Do you perceive a sea change with this agreement?
Yeah, I think this agreement's going to be a template to show the entire workforce, union and non-union, what you get when you join a union. You're going to get wage increases, you're going to get health and welfare, you're going to get pension, but more importantly, you're going to get dignity and respect and a future. This agreement that we negotiated, you know, we protected against technology. We provided for full-time job opportunities. That's the leverage that you have when you're working for the best contract in the industry, and we achieved that.
Sean, we're just going to run out of time here. I want you to speak to the Bloomberg Surveillance Office. There are a lot of fancy people. Let's be blunt. They're probably less pro-union than many. What do unions, what do the Teamsters bring to capitalists to provide for better productivity?
Hey, we bring the best workforce in America. We proved that during the pandemic, not just in UPS, but picking up rubbish, delivering groceries. We provided goods and services. We proved we were essential, and we're going to continue that post-pandemic, and we've got the best workforce in America.
Sean O'Brien, congratulations. All I ask is after UPS, you do something about the Red Sox. Sean O'Brien, Local 25 in Boston, and also with the International Brotherhood of Teamsters there as well. I will never forget, Lisa, the study that was done. I'm going to give credit to Mount Sinai. I could be wrong on that, where they partitioned labor in hospitals during COVID. And they got more done with the union labor than the non-union labor because of the organization structure. That humbled me.
Well, it's a new era, and that's really my question, is how much of the dynamic of a shifting in labor's force, how much is that going to stick?
Is it going to stick? It's a huge mystery out there in the weeks to come. We will see. Not in the weeks to come, in the hours to come. The Fed decides this afternoon.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Live from New York City this morning. Good morning, good morning. It is Fed decision day. Your equity market slightly negative on the S&P. We're down by 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Chair Powell kicking off a central bank trilogy. Alphabet results impress as Microsoft disappoints, and it's the turn of high-flying Meta after the close. We begin with the big issue, one and done, or more to come.
This is likely one and done.
One and done. One and done.
It's one and done.
That's what I would do if I were there.
July, 25 basis points hike.
That's in the cards.
Baked in the cake, the done deal. We'll have to see what happens from there. Really, the only question is what happens after Wednesday.
What kind of signal do they give us for September?
The probabilities of a hike, after July are probably somewhat higher than the markets are currently expecting.
The timing of the next possible rate hike is October-November meeting.
It's going to depend on inflation as well as the growth trajectory.
They'll keep a rate hike on the table.
They want to leave the door open.
To emphasize that optionality.
We'll get a lot more data between now and then to try to figure this out.
Joining us now to try and figure it out, PGIM's Robert Tipp, Troy Gayeski of FS Investments. Troy, first to you, buddy. One and done or more to come?
Yeah, more than likely one and done. Hate to be completely consensus with everyone else, but if you look at the trajectory of the economy, obviously there's early stages of weakening in the labor market. When you look forward, it's tough to figure out where the drivers of growth will be other than consumption, perhaps factory construction or housing rebounding. So the most likely path is one and done, unless housing continues to reaccelerate and the labor market remains incredibly tight, which we think is unlikely.
Robert Tipp, which one is it?
Yeah, I think that is the consensus, and logically, looking at what's happened the last 20 years, you can come to that conclusion. My gut feeling, though, honestly, is that everything we've seen the last 40 years, the interest rates going from 20 to 0, we're going to see about 10% of that 20% drop in reverse on a secular basis. I have a feeling, this is not going to be a hugely inflationary environment, but you look at what's going on out there in terms of wages. If you listen from the bottom up from our credit analysts, what they're hearing in autos, in airlines, it doesn't really match what's going on in CPI. It looks like a robust economy out there. I think it's what you're going to hear from the chairman today. It's going to be no love. It's going to be, you can do what you want, take stock prices up and all of that. But we're going to do our job. We're taking rates up today, and we're going to stand by the ready. We're not going to let this thing get out of control, et cetera.
Well, let's touch on that a little bit more, just on the market stuff before we get to the news conference. Troy, 12 months ago, you'd sense annoyance from Federal Reserve officials if the market was where it is right now, if spreads were as tight as they are currently. Do you think the market cares, or rather the Fed cares as much about where the market is currently?
Yeah, it's a remarkable point, John, because as we've discussed in the past, I mean, financial condition tightening is one of the key channels for the Fed slowing inflation and the economy. And when you look at where financial conditions are today, on almost every metric, they're almost as loose as they were, at the end of 21. Obviously, the front end notwithstanding and the back end of the yield curve, but in terms of equity multiples or credit spreads, so bottom line, though, is when you look at the trajectory of inflation, the Fed has had success so far. Obviously, cores come down, CPIs come down substantially. I think the main worrisome point, and this gets to your other guest's statement, is that you continue to see incipient signs of inflation reaccelerating. The fact that the housing market's rebounded already as strongly as it has due to limited supply. Tom and Lisa were talking to the Teamsters Union head before and mentioning how the power that labor has now, which is very reminiscent in the 70s. So, I think bottom line is they hike once, they keep the optionality to hike further, but they're not overly obsessing about equity risk premium right now or credit spreads relative to the trajectory of core inflation, service inflation, as well as CPI.
Just on the prospect of inflation reaccelerating, Troy, if we can follow up on that. I heard that from Max Kettner of HSBC, Francis Donald of Manulife, Andrew Honhorst of Citi. Andrew and the team have been writing about this for weeks now. This idea that post the summer you get this reacceleration. Do you think there's a chance that we get that, Troy, even with a deceleration in growth? You can get a reacceleration in inflation. And the reason I ask this question at the moment is because of Europe's experience. Germany in recession, inflation still sticky.
Yeah, no, again, when you think back to how these inflationary cycles work and, the fact that all of these, whether you're printing money and cutting rates or you're hiking aggressively and shrinking the balance sheet, have these variable lags. And it's just like in markets, right? Like markets don't go down in a straight line. They don't go up in a straight line. Same for inflation. You have the base effect. You have the fact that owner's equivalence rents has been so important to driving inflation higher, and now the expectation of lower. But as that trajectory changes, you could see CPI fall, you could see core fall. And if the labor market remains this tight, which we're highly suspicious of, as you know, you could see that modest reacceleration, which does lead to one further hike. We think it's unlikely, but it's still in the cards, given the variability and uncertainty surrounding these forecasts.
Robert, what's your take on the same thing?
Yeah, I think you answered your own question there. Europe, they're stagnating and they have higher inflation than the U.S. on a core basis. That is where you do not want to be. So while on the one hand, the credit conditions, the stock market, seeing that kind of exuberance, does the Fed want to stop that? It's not going to make them happy, because I think they're concerned about afterburners, and that is something that on the margin they want to work against. Having said that, you want growth. That is what puts them in a strong position here, is if growth is really on a solid footing, then they can move tentatively forward, do some further rate hikes, bring about a landing on inflation, even though I think it's going to take a couple more years than they're thinking it's going to take. That's what it's looking like.
Two-part story today. Decision, 2 p.m. Eastern Time. 30 minutes after that, you'll hear from Chairman Powell in the news conference. Mike McKee's in D.C. He'll be there. Morning, Mike.
Good morning, John. Well, somebody asked me yesterday what the bond market is telling the Fed, and right now I have to say they're telling the Fed what day of the week it is, because they change their minds constantly. Look at where we are in terms of anticipation in the futures markets. I'm looking at overnight index swaps. 97% priced in a rise today, but only 19% for September. If there is another rate rise, only 28% in November. But look at December. They're starting to price in rate cuts again. That's going to be Jay Powell's job today in the news conference, is to keep markets from doing that. And by that, he's probably going to be focused on inflation, and the CPI reports say one good CPI does not make a trend. No, we're going to keep an eye on this, and we are not going to be cutting rates this year. There are headwinds and risks ahead, and you've been talking about some of them with Troy and Robert, and another hike will depend on the data. Basically the same things that he has been saying. Now, here's a question, though, for Troy and for Robert. What are you going to do at 2:30? Remarkable story by Yi Xie and Matt Bosler from Bloomberg News today. During the news conferences, the markets have gone the opposite direction from what they did with the statement, and people have made a lot of money, at least up through February of this year. It's tightened up just a little bit because there's a little bit less uncertainty, but the bond market goes in the complete opposite direction during the news conference, as you can see. So the trade seems to be take a position on the statement and then bet the reverse while Powell is speaking. We'll see what happens today.
So, Mike, before I get to the panel on that, can we talk about the statement just briefly? There's a couple of lines in it that jump out. The lines around additional firming will be a focus for you, I believe, in the third paragraph. In the first paragraph, at the very end of it, they characterize where they see inflation currently. I wonder if, Mike, they're still going to describe that as elevated or give a little nod to the developments of the last couple of months.
My guess is that they will still describe it pretty much the same language. I don't think we'll see a whole lot of change in the statement because they don't want to give the markets an opening. If they acknowledge that inflation is coming down, then do people pile into that rate cut trade ahead?
Mike McKee, thank you, sir, down in Washington, D.C. Looking forward to the news conference a little bit later on, 2:30 Eastern time. 2 p.m. is when we get the Fed decision. Mike, thank you. Just to familiarize you all with the statement at the Federal Reserve from the last meeting, inflation remains elevated, the last line of that. Troy, do you expect that line to stay in a little bit later today?
Yeah, I think so. I think so because, again, from their perspective now, they have made tremendous progress. There's more progress that needs to be made. You know, the path from, 4% core to 2% core is harder than, 6 to 4. And there's really no upside to removing that language. Right? Like, what's the upside? If they remove the language and then equity multiples go up another 2 multiple turns and we start having more credit expansion, which is obviously counter to constraining inflation. So from a risk reward standpoint, it doesn't make sense yet to remove that language. But to your point, they should give some nod to the fact that tremendous progress has been made. And at the end of the day, it's a delicate balance between continued labor market resilience and really crushing inflation, with a very strong boot, so to speak.
It's obvious also there's a split committee over on the FOMC right now, Robert, and I just wonder how you imagine he's going to deal with that in the news conference.
Yeah, I mean, I think these committees, they help. At any given point in time, you're going to get a wide range of views. You're going to get people that are looking deep inside the numbers, into all the corners of things that are decelerating. And then you're going to get people that bring it right back up to the top level and say, hey, listen, these are high numbers. You remember our narrative about the 70s and not wanting to repeat that. So I think, that gives them a very broad framework, is very inclusive as to possible scenarios. And that will get encapsulated, and it comes across as equivocating, but I think that's a healthy process. I think in terms of the market pricing of cuts, I think what you're seeing there is, rates have gone up 500 basis points. There's always a chance of a disaster, and there's an element of the market's pricing in a 2.5% chance of 500 basis points in rate cuts if something bad happens, and a 97.5% chance of no change for the rest of the year. I think that's what you're looking at. Personally, I think the markets are underestimating the kind of the meat of the scenario around here, of the probability spectrum right around these levels, where it could end up being a little bit higher. As Troy was saying, you could get one more hike after this one, to the extent that you have, a couple months of positive data or inflation coming back up on the upside. But there's a lot of different ways of looking at this, yeah. And I think the base case, for a lot of people, is a couple cuts over the next year, let's say.
Well, Robert, let's build on that and push it through the bond market if we can. What are you doing with the 10-year? What are you doing with the long end of the curve? Have you been buyers in and around 390, 380?
I think you have a real conflict here between the strategic view on the market and kind of the guts and the tactics of the curve. So from a strategic standpoint, rates have gone up a ton. You're at nearing the end, the final stages of the rate hike cycle. You're at a high interest rate level. Bonds are going to do well over the next 5-10 years. I think that's clear. In terms of what you buy, do you go into high yield? Are you buying your AAA high spread structured products that are floating rate, kind of barbell? And the reason for that is because the meat of the curve is expensive. Kind of your 2 to 10 year cash flows that are rock solid, assuming the Fed funds rate is going back to 3%. That particular part of the curve is overpriced. So I think bond market strategically looks great, but in terms of the internals, there's a lot to do to make money in terms of that wrinkled shape of the curve.
Troy, same question to you. What do you buy?
Yeah, Robert makes some really excellent points. And look, we would say from a real yield standpoint, you obviously have much more value at the back end of the curve now. Massively inverted yield curve notwithstanding, it's actually one of the expressions that we ramped up recently in our multi-strategy fund. And one of the key reasons for that is, again, when you look at the probability distribution of recession versus continued high inflation, it's certainly skewed in the direction of recession now, whereas the last 2 years, that was really an extremely low probability event. So we do like that for the first time in a long time. Secondarily, to Robert's point, if you look at structured products, whether it's CMBS or whether it's CLOs, you don't have to go down in the capital structure now to earn 7, 8, 9% type total returns, which, when you think about where equity multiples are relative to history, it appears to us to at least be competitive with equity returns at this starting multiple. And then in terms of more private strategies, you think about the environment for lending right now. Obviously bank lending stagnated after a surge last year and early this year. There's tremendous regulatory pressure and funding pressure on banks to retrench. So it's a great opportunity to be a private lender. However, you need dry powder to actually take advantage of it. And that's one of the key nuances that investors have to flush out as they're deciding which direction to go.
Hey, Troy. Thank you, sir. Alongside Robert Tipp, Troy Gayeski there, going into the Fed decision a little bit later. Thanks to you both. Equities right now on the S&P 500, negative 0.25%, about 15 minutes out from the opening bell. With some movers, here's Abby.
One reason those futures are down, John, has everything to do with Microsoft. Shares are lower. This, of course, after the company basically beat the surface level numbers, but folks are disappointed by revenue growth of 8%. This as the cloud slowed to 27% revenue growth from 31% in the previous quarter. That is weighing that stock down about 3%. And of course, one of the biggest weights to the S&P 500 and the biggest weight to the NASDAQ 100. Alphabet, on the other hand, up 6.1%. There was a big revenue beat driven by stable trends in ads on Google search, up 38% on the year into today. So now we do have some catch-up potential for this mega cap tech stock. And then finally, Boeing up 3.9%. They produced nearly $2.6 billion in free cash flow as jet deliveries surge and customer deposits come in. That is a 38% jump. They saw a 38% jump in some jet production. That is encouraging, John.
Abby, thank you. Thank you very much on the latest. Today is absolutely stacked. Meta after the close. Looking forward to Romain Bostic and the team, Scarlet Fu, Katie Greifeld breaking down those earnings for you later on this afternoon. That's Meta. Then we've got the Federal Reserve as well. There is a consensus around the Federal Reserve, the FOMC meeting and Chairman Powell, just the belief that it's one and done. But still, even though people believe it's one and done, the chairman's not going to commit to the done part. I've read this about 15 different ways. This was from George Concalves of MUFG in the last 24 hours. Likely the last hike, but they'll stay data dependent in case inflation flares up again. Maybe that's what we'll hear from Chairman Powell at 2:30 Eastern. Coming up on this program, this earnings season, it's all about one thing.
I look at this as a 1995 moment, biggest transformation that we've seen in tech in 30 years. This is just what's going to lead, obviously, despite Fed and macro. It's the start of a new tech bull market.
The latest on the AI effort. Alphabet impresses, Microsoft disappoints. It's Meta coming up later.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
City. From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
He
story.
is there, the kind of upside.
I look at this as a 1995 moment, biggest transformation that we've seen in tech in 30 years. I believe Microsoft, a year from now, it's going to join Apple in that $3 trillion, I think 3.5 trillion. They're stronger and get stronger. If you look at Microsoft, you look what we see out of Alphabet, that was a huge flex the muscles corridor for them.
The future of AI in focus after another mixed bag of tech earnings. Alphabet topping estimates thanks to its Google search engine. Microsoft seeing a slowdown in the cloud, overshadowing growing excitement for its new AI products. The CEO, Satya Nadella, saying, we remain focused on leading the new AI platform shift and helping customers use the cloud to get the most value out of their digital spending. Let's get to the team coverage. Mandeep Singh, Anurag Rana of Bloomberg Intelligence. Anurag, first to you. What went wrong at Microsoft?
Only the expectations. Otherwise, the results were pretty good across the board. Almost every segment was slightly better than consensus. And the guidance was basically saying that the slowdown in tech spending may be taking another quarter or so on the cloud side. But the expectations, I think, were that they're going to see a big bump in cloud usage because of AI. And that's going to probably come only about a year from now.
Well, that's the question, isn't it? How patient do we need to be, Anurag, before we see that translate into real money?
I think it's really a question that, when you look at the software side of it, when you look at something like cloud infrastructure, it's not going to be done overnight. It takes a while to, come up with infrastructure, write those applications, then run those applications. Currently, people are just testing this out. So that's really, it's so subscale at this point that, as I said, it's going to take at least a year to 2 years before we see some kind of big usage on the cloud side.
I noticed that both the CEOs of Alphabet and Microsoft in the quotes in the earnings releases, Mandeep, both led with AI. This was from Alphabet's CEO, Sundar Pichai, who said, our continued leadership in, guess what, AI. Was yesterday just about basic advertising, getting it done for Alphabet?
Yeah, and they talked about their large language model, the new version, Gemini, which they're going to be releasing, a multimodal version of, think of GPT, which is quite popular now. And what Alphabet showed yesterday is they are going all in terms of the AI strategy. The product cadence would improve. And it shows on the search side. I think a lot of people were concerned about the impact of ChatGPT on search volumes. That didn't show up in the results, and you had a nice beat on the search.
If you're a Meta investor, after a run-up of close to 150% year-to-date, Mandeep, did you like what you heard yesterday from the likes of Alphabet?
I liked what I heard from Alphabet, but not so much from Snap. And I feel Snap is a closer competitor to Meta than Alphabet is. And on the social media side, I get the sense it's still, the recovery in ad pricing is still in the early stages. So my sense is, look, Meta is going to do great on the free cash flow side. They're going to pare back on Reality Labs. But when it comes to engagement on the Blue app, that will continue to be a headwind for them, and that's where the top-line acceleration will take a while.
Got it. Mandeep, thank you. Mandeep Singh there. Anurag Rana to the two of you from Bloomberg Intelligence. Thank you. The stocks, the performance obvious. Alphabet is higher. Microsoft is slightly lower. That's the good, the bad, the ugly. As Mandeep pointed out, Snap down by 18% in the pre-market. Coming up on this program, the morning calls, and later, Crossmark's Victoria Fernandez on the big opportunities outside of big tech. Plus, Loop Capital's Rob Sanderson weighing in on the latest results from the tech titans after the close yesterday. And looking ahead to Meta a little bit later. From New York, your opening bell, 7 minutes away.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Minutes away from the opening bell this morning. Good morning to you. Chairman Powell a little bit later, going into all of that, into the open. Equity futures right now on the S&P, slightly negative by 0.25%. That's the price action. Here are some morning calls. First up, Raymond James downgrading target to market perform from a strong buy, cutting shares by 2 notches due to weakening traffic trends and easing sales momentum. Deutsche Bank upgrading Spotify to buy, 180 price target, saying the stock's post-earnings sell-off is now overdone. And finally, Citi raising its Alphabet price target up to 153 following earnings, pointing to a strengthening advertising market and numerous AI benefits. That stock is up by more than 6%. Coming up on this program, Alphabet beats, Microsoft disappoints, big tech results continue with Meta after the closing bell. That conversation up shortly with Crossmark's Victoria Fernandez and Loop Capital's Rob Sanderson. Your equity market slightly softer, your opening bell just around the corner.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
.24 seconds away from the opening bow this morning. Good morning to you all. On a bit of a winning streak on the S&P 500, just a bit softer at the moment going into Chairman Powell Day decision this afternoon. Equity futures down by 0.2% on the S&P. Some underperformance on the Nasdaq driven by what's developing in Microsoft after the close. There's your opening bow. With equity futures just a little lower on the Nasdaq too. Let's turn to the bond market. Yields are lower by a couple of basis points, 386.28. In the FX market, a euro bouncing back, 6 consecutive days of euro weakness, replaced by a little bit of strength. Euro dollar 110.68, we're positive there by 0.1%. WTI just short of 80, $78.88. We're negative there by almost 1 full percentage point. About 20 seconds into the session, the S&P 500 looks a little something like this. We're negative 0.2%. On the Nasdaq, we're just a bit softer as well. The stock to watch at the open, Microsoft, the company posting tepid sales growth and forecasting a continued slowdown within the cloud business. The CEO saying this: we remain focused on leading the new AI platform shift and helping customers use the cloud to get the most value out of their digital spending. Abby has more. Hey, Abby.
Hey, John. Well, it's not surprising that this stock is lower right now, on pace for its worst day since the beginning of June, down about 2% or so, given the fact that on the year coming into this report, it had been up somewhere closer to 50%. So price to perfection to some degree, and that revenue growth slowdown that you're talking about, the revenue growth for the quarter that they just reported, about 8.3%. On that cloud slowdown, not offset by optimism around AI, saying that AI is going to be a little bit, it's going to take longer to get it going, whereas the cloud, that's 41% of their business revenue. So I think that the big concern here, John, is that we could see this slowdown continue. And if you look back at Microsoft over time, between 1999 and 2016, it never made a record high from its bubble peak because of that slowdown. If you look at the Microsoft modeling right now, it has been in single-digit growth for quite some time. So I think, again, the fear is that it will stay stuck here and that that's going to weigh on the stock.
Pretty sure Joe has a moustache now and long hair. Abby, thank you. Very different look. Abby, thank you for that. Just around the opening, about 2 minutes in then, equities down just a little bit. Abby went through one of the losers, Microsoft, one of the winners, Alphabet, topping Q2 estimates thanks to robust advertising within its search business. The company's saying this: generative AI is supercharging new and existing ad products with tons of potential ahead. Mandy, good to see you again. They're saying all the right things. Are you seeing it turn into real money?
Well, so look at how Google is going to grow their top line going forward. One, they have that daily active user base of 3 to 4 billion users to the search product. So they're not going to add more users. They're going to focus on driving engagement. And that was one of the biggest risks with ChatGPT is, can it take away the engagement? And I think when you parse out Google, as a combination of search, maps, and all the apps they have inside, that is where, a BARD or the next version of generative AI could be very powerful in terms of driving engagement. They missed the boat with social media, but I feel that's what they're focusing on. How do we drive engagement? And I think they said all the right things last night.
Mandeep, with that in mind, what does a president and chief investment officer do at a tech firm?
Well, so I think Ruth Porat's elevation is not a surprise given, how well she did with cost cutting this quarter, and they need that focus when it comes to driving the bottom line. I think if you're thinking this company can compound EPS at, low to mid-teens over the next 5-10 years, you need both the top line focus and bottom line. And I think Ruth has that experience, both with her street experience, taking stakes in smaller companies, because Google obviously can't buy any company now. And I can see more of that happening, given what Microsoft did with OpenAI early on.
Mandeep, just quickly, Meta later. I asked you briefly about the read across from Alphabet to Meta, thinking that perhaps we get a lift for Facebook too. And you picked on Snap, and I'm going to talk with Simone about Snap in just a moment. Yeah. Why is Snap the cleaner read on what may or may not happen with Meta later?
Well, so social media advertising is different from search because, the advertiser base is more concentrated, although in the case of Meta, it's mostly small businesses, and we know small business sentiment is improving. I think why Snap didn't do well is, one, a function that their engagement growth somewhat tapered, and that's because of TikTok and all the competition, from Instagram. But I do think, ad pricing has been slow to come back. And right now, what we saw is probably advertisers focusing on the highest ROI spend, which is Google search.
Mandeep, thank you, sir. Snap getting absolutely hammered this morning by almost 20%, a fifth of the market cap, just like that, in the first 4 minutes of trading, getting slammed after delivering a disappointing guidance. The company saying this: we remain in a period of rapid transition as we work to improve our advertising platform despite limited visibility for demand. Simone, that does not sound good, does it?
No, it doesn't. You don't love to hear a rapid transition. Net loss coming in a little bit lighter than anticipated, but as you pointed out, John, it's all about that revenue forecast. This second quarter was the second straight quarter where year-on-year revenue fell, and then when you look out to the third quarter, Snap looking at for $1.07 to $1.13 billion in revenue. Analysts we're looking for that top number. I think you're seeing somewhat of a comparison of what happened at Alphabet, just such strong commentary around ad revenue. Meta's ad revenue expected to come in pretty hot as well, and there are rising costs as Snap invests in things that will draw more consumer engagement. 70 cents per active daily user, up from 58 cents a year ago. There are a handful of encouraging signals, however, if that's really what you're looking for and you believe in the Snapchat product. 397 million daily users, that's up 14% from a year ago, especially strong user growth outside North America. John?
Tell that to shareholders this morning. We're down 20%. Simone, thank you for that. That one brutal, ugly around the opening bell. Let's turn to semiconductors. Texas Instruments posting a weaker than expected Q3 outlook. The CEO saying this: similar to last quarter, we experienced weakness across most of our end markets. Katie has more. Hey, Katie.
Hey, John, even with the bright spot in the automotives, Texas Instruments currently down by about 5% as trading kicks off after delivering a pretty lukewarm forecast. The chipmaker sees third quarter revenue coming in between $4.36 billion to $4.74 billion. Now, the midpoint of that range is below the average analyst estimate of about $4.59 billion. And again, automotive, it was the bright spot here. But outside of that segment, you heard from the Texas Instruments CEO saying that customers, they're continuing to cut their orders of new chips. They're instead choosing to rely on their existing stockpiles. And not to mention, you also have order cancellations hovering near elevated levels. So you add that all together, of course, it's weighing on the stock this morning. And it could have implications for the broader industry here, given that Texas Instruments usually seen as a bellwether, John.
Stock is down 5%. Katie, thanks for that, breaking it down for us for the semis and beyond. We're about 7 minutes into the session. Equities at the moment negative by, let's call it 0.2% on the S&P, on the NASDAQ down by a little bit more. It's a monster week for big tech, but better news could be in other sectors.
I think tech is going to be a loser. Why would you pay 40 or 50 times earnings when you can get companies with superior earnings growth that are cyclical at a fraction of the cost.
There's a lot of anticipation and good news already priced into the mega cap names. There are opportunities elsewhere. We do think that this earnings season could be a catalyst for a broadening out of this rally.
We've heard so much of that over the last few weeks. Victoria Fernandez also looking beyond just the tech sector right in this. We want to be invested but remain cautious throughout the second half. Stay invested and find the parts of the market that will perform best in certain environments. Industrials have begun to show some leadership. Use this sector for some cyclical exposure. Victoria, I'm pleased to say, joins us now. Victoria, let's go straight to it. Why do I want to buy cyclicals with month after month after month of declining leading economic indicators and an inverted yield curve?
Yeah, it's a great question because, as you know, we actually anticipate a slowdown later in this year. So you're right. Why do I want to be in cyclicals? But I think it's because you have to have a balanced portfolio, Jonathan. So many people have been focused on that tech sector. And you know, for a long time, we were actually trimming those high-flying names because we didn't want to have so much exposure to those names. And we were looking in other areas within tech. But at the same time, we said, look, you can't underestimate the consumer. We do think there's going to be a pullback later this year, but the consumer continues to spend. We heard it from Visa, where they said they don't really see that much of a slowdown in consumer spending. So I think you need to have some exposure there. Like I said, industrials have been taking a leadership role, so maybe you can look at some of those names. Construction has actually been moving higher. Manufacturing construction of plants has actually doubled in the last 12 months. So look at some companies maybe associated with that. And I think you also want to have some staples in your portfolio just to give you that diversification within your portfolio for the volatility we see ahead.
Well, talk to me about what's funded that. I'm looking at what you've trimmed. Hilton, Bank of America, Kroger. Why those three names? Do they have anything in common?
Well, what they have in common is their outperformance over the last month and the trends that we're seeing. So obviously there's been this whole revenge travel going on all summer. But we heard from Alaska Air yesterday where they're seeing domestic travel really start to slow down. We saw Southwest come down a little bit because of that. So domestic travel coming down means hotels will probably not do as well. Hilton has had a really strong month. They were up over 10%. So trim a little bit of that name. You don't have to come out of names completely, but take a little money off the table, appreciate your wins. It's the same thing with Bank of America. 10% in a week. Why would you not trim some of that and look for other areas, names that have been hit, and put some money there? And Kroger is the same way. They've had strong performance, 5% performance as of late. We're starting to see food inflation maybe go back up again. You look at grains, especially wheat. We're seeing commodity prices move up, so there could be some margin pressure there. Go ahead and take some wins. That's the theme across the names.
So this is the equity market. My question to you to start this conversation, why buy cyclicals with the data going in the wrong direction, the leading economic indicators? Why buy cyclicals with an inverted yield curve? Here's the question on credit. Why do I want to buy credit as defaults start to pick up? Make sense of that for me.
Well, it depends on where you're buying within credit. I agree, high yield spreads are so tight right now. And to me, that's a warning sign in the sense that we know if there's going to be a slowdown, we know if there's going to be margin compressions coming in as inflation comes down and pricing power is affected, those high yield names are going to be affected first. So I would avoid high yield. I would look at investment grade names. And within that sector, yes, spreads are tight, but I think those companies that have strong balance sheets, that have good cash flows, those are the names you can have bonds in, whether it's short term to get higher yields on the short end, combined with a barbell on the longer end of the curve to lock in some yields, because I think yields are coming down. We probably hit that peak yield back in the fourth quarter of last year for this cycle. So if yields are coming down and you've got good quality credit names in your portfolio, you can cash in on your coupon and maybe get a little bit of spread tightening still with those names, and you'll be well positioned.
We've been talking for more than 5 minutes and haven't even mentioned the Fed on Fed decision day. So here's a dangerous question. Do you care what Chairman Powell's got to say at 2:30 Eastern? Does it make a difference to your investments that you've just walked us through?
It doesn't make a difference in the near term, Jonathan. We know they're going to hike 25 basis points, or at least I say we know, 99% on the futures say that. And they're probably going to be hawkish. I think people are anticipating that. I don't think there's going to be any surprises that are going to change my outlook on the economy. I think we're going to wait and see what is said at Jackson Hole. We know there's a longer time period than usual between this meeting and the September meeting. Jackson Hole's right in the middle. Let's see if that's where they start to change their story a little bit. That's going to be more interesting to me than what we hear today.
Interesting. Victoria, thank you. Victoria Fernandez there, Crossmark. On this market, what she's been trimming, what she likes in equities and in credit, and looking ahead to Chairman Powell a little bit later at 2:30 Eastern. Just to go through the calendar for you, August 10th, that's going to be an inflation print. Then on September 13th, another CPI read. So they're the two CPI prints between this Fed meeting and the September meeting, which takes place at the back end of September, around September 20th, I believe. Back end of August is when you get Jackson Hole and potentially an address from Chairman Powell. Any rush to commit to a pause? Today in the news conference, consensus, as consensus stands, the belief is there will be no rush to commit to a pause later on this afternoon. We'll see full coverage, of course, coming up a little bit later on Bloomberg TV and on Bloomberg Radio. Coming up on this program, looking ahead to Meta earnings.
When we look at the performance in some of these big tech companies so far, what we need to wonder is how sustainable it's going to be.
It is one of the big winners of the year so far. That conversation up next with Loop Capital's Rob Sanderson.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
look at the performance in some of these big tech companies so far, what we need to wonder is how sustainable it's going to be. And AI is an exciting story, and eventually it's going to translate into earnings, and there's no question about it. What we need to determine is how much time it's going to take.
Microsoft and Alphabet setting the stage for Meta after the closing bell. Investors looking to earnings to justify the stock's monster gains this year. Year to date, Meta up by more than 140% already in 2023. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, we'll see if the year of efficiency continues to pay off for Meta. Of course, even though shares have tripled since November, that was off a 7-year low. And if you look at valuations right now, Meta currently trades at 20 times its projected earnings. That's a lot, but then you look at the NASDAQ 100, and that trades at 26 times. So we'll see. That's the valuation backdrop. But I want to talk about the fundamental story for Meta because it is fascinating. Of course, there's going to be a lot of focus on the metaverse, of course. Maybe we'll figure out what it is. There's going to be a lot of focus on ad sales, of course, given that Meta derives nearly all of its revenue from advertising, and there's going to be a lot of focus on Threads. Of course, that's Meta's challenger to Twitter. It launched this month, Twitter, now known as X. There's a lot of lofty projections for what Threads could deliver to Meta's bottom line. Evercore, for one, estimates it could generate $8 billion over the next 2 years. I'm sure we're going to hear a lot about it in the next few hours.
Katie, thank you. I think we're all waiting for this one. Year to date, Meta up by close to 150%. Loop Capital's Rob Sanderson looking ahead to results, saying this: recent conversations with advertising industry contacts point to continued resilience in digital ad markets and are particularly encouraging. Rob, I'm pleased to say, joins us now. He has a buy rating on shares of Meta. Rob, I've been looking forward to catching up with you because I was reading your research yesterday evening, and this is a line you don't usually read around a name that's up triple digits year to date. South-side expectations for Meta look conservative. Rob, what's conservative about them?
Well, I think people have accurately captured the cost reductions, and that's been the bulk of the revaluation in the stock this year. And that's less interesting to investors. I think the efficiency is certainly important to the bottom line, but it's sort of a one-time thing, and it's priced into the stock. What we're excited about is revenue acceleration, and I think we're looking at like we heard from Google last night, pretty healthy trends in ad markets compared to what was initially a very cautious expectation. So better than expected, I think, is the takeaway versus the backdrop. But Meta's really getting its mojo back in product, and that's, I think, very important for the stock and for the multiple.
Before we get to product, let's just sit on ad spend for a little bit more. Rob, I had a guest on a little bit earlier this morning who had a different opinion on things and said that maybe Snap was a better read on ad spend than Alphabet, rather, for the likes of Meta. Why is Google a decent read compared to, say, what we heard from Snap?
It's about 70 times larger in terms of advertising dollars. Snap's a very small player in a big ocean. Obviously, the revenue scale of Alphabet is unlike anyone in the space, including Meta. But Snap is a very small player. I think moving through some very company-specific issues. And, the incremental dollars there really wouldn't move the needle for a company the size of Meta or Alphabet.
You mentioned product as well, so let's switch to that. Threads. Sure. Rob, is it too early to get excited about Threads?
I think so. I think Threads is very nascent in its, it's a curiosity at this point. Certainly has long-term potential, but again, Meta's business is really driven by the core apps, and they're so scalable. Even if Meta were to replace Twitter's revenue base completely, it's like 5% of advertising revenue for Meta. I think it's quite early to be excited about Threads from a moving the stock perspective. I think it's really about the core ad products, and Reels is really the star of the show here, not Threads.
What are you seeing in Reels, Rob, that you think can underpin a re-acceleration in revenue for a company that large?
Yeah, well, the engagement growth has been phenomenal. That's something that's been, I think, known for some time. The time spent on short video products, TikTok, obviously very well known. But Reels is distributed to, Meta has 3 billion daily active users. The reach is unparalleled. And now it's not just engagement growth. We're really hearing strong indications from the ad buying community that the platform's performing very well, not just for brand objectives, but now for lower funnel, performance objectives as well. And a lot of money is moving into this exciting new format, delivering fantastic results for advertisers. And I think there's a lot more to come here.
I'm with you on the doom scrolling, Rob. I've now set a limit on my phone to about 2 hours because of these short videos, which you just keep sweeping through. Rob, can they actually make that much money from advertising on that?
Yeah, they can. The engagement's phenomenal, as mentioned. But it's working. That's what we're encouraged about. Is when we talk to advertisers, they're getting results, and they see a very significant amount of headroom to continue to put more money into this format, and that's on top of what is already working in stories and feed and other formats across the Meta platform. The other product story is on Advantage Plus. This is an ad platform for advertisers that's using AI to help manage campaigns very early in its ramp. And again, feedback's been incredibly positive. And together, I think this is really helping Meta get some of its mojo that was lost over the past few years. Their reputation in the ad community is certainly on the upswing.
Super addictive, that's for sure. Rob, enjoyed this. Thank you, sir. Rob Sanderson there on Meta coming up a little bit later. Just things you don't usually hear. Triple-digit gains, and you've got an analyst bullish saying that maybe things are too conservative, switching the focus from the price cuts driven by the collapse of the stock at one point last year. And now we're talking about the product and a re-acceleration of revenue. Meta seems to be getting it done. The results coming up later. Let's see if they can disappoint or impress with a pretty high bar going into results. From New York this morning, your trading diary up next.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Equities down just a little bit. That's the price action. Here's your trading diary. What an afternoon. Chairman Powell coming up at 2:30 Eastern. Decision time at 2 p.m. Meta after the close tomorrow. An ECB rate decision. US GDP onto Friday. We round things out with the BOJ. We round things out later with a stacked lineup for Fed coverage. Bob Michael at JP Morgan Asset Management headlining that for you. Plenty of others as well. Looking forward to catching you a little bit later from New York. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Moment news breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup.
This is a 3 as the economic picture does. The BOK is getting ready to make a decision.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Brokers studio in New York City to our worldwide audience. It is Fed Day. We will get a preview of what we might hear from our Federal Reserve Chairman later on this afternoon. Plus, we're going to do a roundtable with some of our senior technology analysts from Bloomberg Intelligence, break down some of these tech earnings, Alphabet, Microsoft, all that kind of stuff. So good stuff coming up. Johanna Gallegos, co-founder of Bond Blocks, talks about ETF investment strategies in the fixed income space, not equities, but fixed income ETFs. That's all coming up. But first, let's kick things off with John Tucker and get a Bloomberg business flash, John.
And right now, Paul, stocks and yields mixed ahead of the Fed rate decision in the news conference. A biggest drag right now for the NASDAQ 100, Microsoft, after investors focused on the company's cloud business in the latest earnings report. The decline in the index limited by the lift that it's getting from Alphabet after their earnings showed some stable ad trends. And the quarter point, that's penciled in. Anika Gupta at Wisdom Tree says it's all eyes on the Fed chair, Jay Powell, today for what's next.
The outlook and the forward guidance that he's likely to give for upcoming meetings. That's going to be quite interesting. We don't have everyone on the same page at the Fed, being convinced that inflation is on track to reach its 2% target.
Right now, the S&P 500, 6 points lower. That's down about 1/10%. 45.61 on the index. The Dow Jones Industrial Average, 40 points lower. That's down 0.1%. The NASDAQ 100, right now, 40 points lower. That's down about 0.25%. Finally, Gap is betting an executive who helped make over Barbie can revive the faded apparel giant. Richard Dixon, he's the president and chief operating officer at toy maker Mattel, taking over as Gap's next chief executive officer. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Madison and Paul.
All right, John Tucker, thank you so much. We appreciate it. Sitting in, Paul Sweeney here. Madison Mills joins us in studio. Good morning, Madison.
Hey, Paul.
All right, we are here in our Bloomberg Interactive Broker Studio. We're also streaming on that YouTube internet thing, so you can head over to YouTube and search Bloomberg Global News, and you can get the video feed of this fine program. What's better than that? Looking at the market here, just a little bit of red on the screen, not too much. Waiting the Fed this afternoon at 2 p.m. They'll have a 2:30 press conference. Bloomberg, of course, will have full coverage, simulcast radio and TV. Tom Keene and their surveillance team, Lisa Baranowitz and John Farrow, at 1:30 p.m. Wall Street time. So check that out for full coverage of our Federal Reserve. Let's see what's happening in the markets here. We welcome Alexandra Semenoff. She's from Bloomberg. She covers all of the market stuff for us. She joins us here in our Bloomberg Interactive Broker Studio. Alex, what are you looking at today?
Good morning, guys. Great to be on with you as always. We got to talk about Gap today because that's the big story this morning. Shares were up about 7% last time I looked. After news, of course, broke that Mattel Chief Operating Officer Richard Dixon has been tapped as the new Chief Executive Officer at Gap. Both companies released announcements today, sending shares of Gap up and shares of Mattel down. This concludes a year-long CEO search for Gap. Mattel told its staff about the departure today, just after the incredible success of Barbie's opening weekend. Dixon is the one credited with reviving the Barbie franchise, so this is really a big win for Gap. Bloomberg intelligence analysts say that its turnaround prospects just got brighter. It's already saw improvement in its inventories and cost savings in new brand design processes, and it really took the time to select the perfect CEO. So this is set up to help Gap continue its upward trajectory. Dixon already sits on Gap's board and has apparel experience from stints at Bloomingdale's and Nine West. So very positive for Gap. You can see that in the share moves today, and a loss for Mattel. Shares are down.
Right. I feel like I can't get away from Mattel this week when it comes to stories I'm looking at, and we've got their earnings coming up. Is today Wednesday?
It is, absolutely.
Yeah, their earnings are coming up later today.
Earnings galore.
So I'll be watching that for the first time in my life. Alex, what are you looking at when it comes to other earnings, particularly in the tech space? How's that looking?
Yeah, so we're seeing a tale of two different tech stocks. We've been talking a lot about how this quarter Wall Street is gonna scrutinize artificial intelligence a little bit more, and they really want to see what companies have to show for all the times that they have been using the buzzword, and we're seeing that in Alphabet and Microsoft today. Alphabet is up about 7% after reporting earnings that beat expectations, helped by advertising in its search business. Analysts also noted that its cloud unit is benefiting from rising demand for AI. Really interesting analyst commentary. JP Morgan called it this a clean earnings report, said that it struck all of the right notes when it came to emphasizing its AI leadership, stabilization in advertising, and progress on cost structure. Citi said that Google is witnessing tangible benefits from AI, but then you look at Microsoft and it's a totally different story. Shares are down 3% after it showed a continued slowdown in its all-important cloud services business. I have to read off the analyst commentary here as well. Citi said that results were satisfactory, but they lacked spice, the spice that investors may have been salivating for when it comes to artificial intelligence. So
Sell-side analysts wrote that? Really?
Indeed.
Oh.
I love these hilarious quotes off of the earnings calls. Like, I can't wait to ask Anurag about some of the spicy commentary.
They know that we have to have something to talk about on the show.
Exactly.
That's so true.
All right, we're going to have more coverage of that in-depth analysis of those tech earnings just in a couple of moments. Bloomberg Intelligence senior tech analyst Anurag Rana and Mandeep Singh will both be in studio, so we'll break that down. There's also a M&A trade here in, I guess, the regional bank business out there, PacWest or something?
I got to get back to you on that, Paul. I've been covering all of
Gotcha.
them.
Okay, because I saw that and it was kind of pretty cool. I thought we got a little bit of a deal there, so we'll see what happens. Maybe I don't know. I kind of feel like regional bank M&A is going to be a huge thing over the next several years. I think the financial crisis kind of highlighted the fact that maybe we have too many banks out there, so I don't know.
Yeah, and it does look like, pulling up some stories from Bree Bradham on the terminal, she's our banks reporter on the equities team. Looks like PacWest jumped as much as 31% on Wednesday following news that it's being bought by that rival Bank of California, which is also up. So that's interesting. You don't always see two rising ships when it comes to an acquisition there.
Exactly right. We got the Fed day today, Alex. I mean, What are you hearing from the street on that?
Yeah, so really interesting stat here. We're used to seeing very sizable swings around FOMC decisions. If you look at what happened in 2022, the S&P 500 saw moves of as much as 6% in each direction within 5 days of a rate decision. In 2023, however, the S&P 500 has only made moves of less than 1% in either direction within that 5-day period. So it's really showing that the Fed no longer has this chokehold over investors, that they're largely anticipating the end of the rate hiking cycle. Even if today they do signal that we could get another rate hike later this year, they are pretty optimistic that it is over. To be sure, some have flagged the risk of a resurgence in inflation and the possibility of a hawkish surprise later this year. So that's something to watch for in Jerome Powell's press conference today.
All right, and again, we're going to have full coverage of that thanks to our surveillance folks. They'll start their show regarding the Fed at 1:30 Wall Street time. We have Bloomberg's Michael McKee. He's actually down in D.C. We put him on the Acela train yesterday, so he's down there for the press conference. He'll have some Q&A with Fed Chairman Jay Powell. Alex Semenoff, thanks so much for joining us. Appreciate it. Alex, she covers all the markets for Bloomberg. All right, we want to bring in a couple people that they tell me are experts in technology. I find that hard to believe. I mean, but we'll see if they can earn their supper here today. Mandeep Singh, Anurag Rana, they are tech analyst at this thing called Bloomberg Intelligence, BI-GO, on your Bloomberg terminal. So we'll see how they do here today. All right, so let's start with you, Anurag. Microsoft, I don't know. I thought it was a good quarter. If there's dips, if I were PM, I'd be buying the dips here. What did you take away from Microsoft? Stocks had a rip this year.
I think that's what it is. It's had a rip, and people are just digesting the news. I think it was a good quarter, as you said, but people, I think, had unrealistic expectations that the AI workloads is going to blow out the cloud number, which I think will happen over the next 12 to 24 months, but it's not immediate. It's just going to take some time.
Well, in terms of things that are going to take some time, I feel like that also applies to the AI play with Alphabet, Google. What are you thinking, Mandeep, when it comes to whether that AI chatter is going to translate into actual money for Alphabet?
Well, so the good thing for Alphabet was yesterday the expectations were somewhat muted around search and YouTube. And what they showed was this business is as resilient as it can be, even in an environment where ad pricing is still facing some headwinds. But I think what Alphabet showed yesterday is, one, they are able to keep the engagement. So concerns around ChatGPT eating their lunch were overblown. And then on the cloud side, it was a pretty strong number, 28% growth, $32 billion run rate for cloud. That's pretty impressive. And now cloud business is not a drag on profitability as it was last year. So I think net, I mean, they're kind of optimizing the cost side of the equation. Ruth Porat actually was elevated into the president role. And look, I think once you start to see a rebound, cyclical rebound in ad spending, you will see double-digit EPS growth in this name. Wow. They can compound for the next 4 or 5 years.
All right, so let me ask this. Either or both of you guys I want to hear from. Matt Miller tells me ChatGPT, Bing is like awesome, and that Google doesn't have a chance. What do you guys think about that?
Well, last night they showed the search revenue grew a robust 5%. So
okay, when I was covering Google, if they put a 5% print up, we take them out to the woodshed. Well, now you're telling me it's robust?
And YouTube Premium, that was the real standout. So YouTube ad revenue grew 4.5%. Premium, which is incorporated in their other segment, grew 24%.
Okay.
Compare that to a Netflix and Spotify. I mean, they're having all sorts of issues with churn, raising prices. In the case of YouTube, this is like YouTube Premium is almost an $8 to $10 billion revenue business, growing high teens. So they are taking share when it comes to streaming, and it's a higher margin business than Netflix because this is all user-generated content. So.
Full disclosure, Bloomberg Markets is on YouTube.
There you go.
Just saying. All right, so Anurag, what does Microsoft say about ChatGPT, Bing? Is it a thing?
So for Microsoft, search revenue declining and going to be weak next quarter, and LinkedIn, which is based on advertising, declining and going to be weak next quarter. So we can tell that to Matt Miller.
Google really is a standout.
Exactly.
And Snap had some weak numbers too, right?
So social media ad pricing continues to be weak. We'll find out from Meta if that is the case, or Snap is, a standout in terms of the weakness. But I think search, we know, has the highest ROI when it comes to ad spend. And in the case of Google, clearly the ad pricing was much stronger than others.
So is there a potential read-through of the bad Snap numbers on advertising to Meta, or is Meta such a behemoth that you can't read?
I'm in the camp that Meta's ad pricing numbers will also be bad.
Okay.
Meta is doing well in terms of cost cutting, and they obviously are the scale player when it comes to social media. But this will still be a weak ad pricing environment for Meta as well. I think Reels may be a bright spot, given they have talked so much about, competing with TikTok and Threads. We'll find out more about it. I think they're going to pare back on their Reality Labs ambitions, the whole metaverse thing that was a big drag last year. But it's still, when you compare Meta's story, it's a combination of 4 of their most prominent apps. And the Blue app, which is about 40 billion run rate in our view, is still declining. And that is a tough void to fill when it comes to the top line.
Meta stock up 148% year to date, up another 1.5% today. Go figure. All right, Anurag, when you talk, I know you and Mandeep and the tech team have put together this seminal report on AI. How do I find it on the Bloomberg terminal?
You can go to BI, INET, Internet Dashboard.
And that's where it is.
Yes.
Okay, so that is the seminal report. If you want to know what AI is and whether it's a scam or a crock or whether it's real, like Dan Ives from Wedbush Securities says, you can go there and check it out. So BI space INET, you can find that report there. Anurag, when you talk to institutional investors, how are they playing? First of all, how do they view AI? Is it a seminal event in tech? And if so, how do they play it?
I mean, from our side, in the software side, it is the cloud providers that are going to really benefit from this, because you have to build those applications in the fastest processing environment, and that can only be on the cloud. Right now, Microsoft has an advantage because of its OpenAI relationship. We think Amazon will catch up over the next 6 to 12 months. We think Google's already there with their products. These 3 companies will benefit more than anybody else on the software side.
Well, I know that you know this, but I love the funny quotes from earnings calls, so I'm just going to repeat it for our audience. The AWS CEO said yesterday, kind of taking a shot at Microsoft, it's interesting that somebody who's not running their own models, like Microsoft, which outsourced to OpenAI, would argue that they've got such deep expertise in this area. What do you make of a comment like that?
See, but for the first time, Amazon's feeling the heat.
Yeah.
They haven't felt that in last 10, 12, 15 years.
They never have competition.
They have a massive competition now with Microsoft because they are coming up with products on a monthly basis. The pace at which they are coming up with add-ons to their core products such as Office, GitLab, it's just remarkable how that's happening. So, they have to be feeling pressure at this point. I think there's a little bit of that. I think Amazon Web Services is going to be weak next week when they report, and let's see what he says then.
All right, Mandeep, the ride-sharing biz. Well, what are we going to hear from the Ubers and the Lyfts of the world? And again, I am agnostic between the two. Whatever's got the lowest price, that's how I go.
So far the story is Uber is taking market share. Lyft has lowered prices to reclaim that share, but we know this is a scale business and there is a big focus on profitability this year. So clearly Uber is in a much better situation. The delivery side, I think, will continue to be a drag on their overall free cash flow. And the CFO transition, I think that was the other big news with Uber. So something that I think investors want to know more about.
Will those third-party partnerships be a tailwind for them heading into earnings?
For
with
Uber?
Domino's, yeah.
Yeah, I think, look, if everyone realizes that they have the traffic when it comes to, people looking for a meal or a ride, Uber is the go-to place, it's a verb. And so every big chain right now is looking to partner with them just to be on the platform. Domino's is still doing their own delivery. So they're not bank, and so that is what was interesting. They're just using them as a customer acquisition channel for people who are ordering online.
I just don't get it. Over the last 5 years, Uber's compounded annual return has been about flat, okay? Lyft compounded annual return over the last 5 years, negative 30%.
Wow. Huge.
Is it all because of Uber Eats? Which I don't do, by the way. I think the charges they put on for like a $20 pizza is ridiculous. But
it's a tough business. 3-sided marketplace. It's a low gross margin